2.7%, yields lower by a single basis point, 468.99. It's all about the data this morning. Under surveillance, the Fed's preferred inflation gauge on deck.
We believe inflation is going to prove more sticky than it has. Sticky for us would be that the Fed's preferred measure, which is core PCE, it may settle at 2.5 versus 2. And the Fed's not, I don't see why the Fed would be, rushing to be cutting rates into an environment where inflation is still sticky. That was true 3 months ago. It's true today.
It's the latest today. The core PCE deflated due at 8:30 Eastern Time. The median estimate in Bloomberg's survey calling for a 2.7% increase from a year ago. It's the last data point ahead of Wednesday's Fed decision. Sarah Wolf of Morgan Stanley writing this: we expect little change to the FOMC statement, but see the risk of a more hawkish press conference. We expect signaling on tapering QT with an announcement of the parameters and start date to begin in June. Sarah joins us now for more. Sarah, let's skip the data this morning and go straight to Wednesday. What are you expecting from Chairman Powell in that news conference?
We're expecting Chair Powell is going to want to be patient, as we already heard from him a couple of weeks ago at the IMF, that the inflation data in the first quarter gave him a lack of confidence that inflation is moving in the right direction. The data we got yesterday only corroborates that we saw a little bit of progress on inflation, but not nearly as much as the Fed would like to see. And in particular, that monthly run rate is looking to be well above the 0.2% on the month that the Fed likes to see to feel confident. So while there doesn't need to be much change to the statement, when the Chair Powell is discussing in the Q&A the risk to the outlook, he's still going to emphasize upside risk to inflation, and that they're going to be patient and need to see more incoming data to feel confident. There's no reason to rush into cuts right now when they clearly need more data.
Yesterday, Sarah, as you know, people were whispering the word stagflation. Let's talk about that data. Just how bad was that GDP print, really? Or how good was it? It was a big downside surprise, but when you look at the details, what was the story?
I think that there's good news. The economy is strong. If you look at private final domestic demand, which captures the domestic side of the economy, so consumer spending, business investment, residential investment, that was over 3% quarterly growth. So that's still a very robust economy. That 1.6% headline number came from trade and inventories, which are very volatile. Likely we see that reverse out in the next quarter. But the good news is that the Fed can be patient because the economy is still very robust. In particular, consumer spending still growing at a very strong pace, 2.5%. We're seeing that more of the dollars are going towards services over goods. So consumers are spending, but they're becoming more picky about how they spend. On the other hand, you mentioned some bad news. That was the higher inflation data. Based on the monthly data that we got for January and February and the inputs we have for March core PCE inflation, we were looking at core PCE for the quarter looking closer to 3.4%. The data came in yesterday, 3.7%. So what are we expecting today? Likely upward revisions to the prior 2 months and probably a stronger March core PCE print as well that we get in 2 hours' time.
Have you changed your view on how many rate cuts this year? Do you think that the market's got it right with one in December and that's it?
We haven't changed our view. In our view, the first cut still comes in July, but the bar is much higher to get to that cut now. We acknowledge that. You basically need to see a 0.2% core PCE inflation run rate the next 3 months in order to meet that bar for a July cut. As we know, the data has been extremely volatile. So putting confidence in just a 0.2% for the next 3 months is looking more shaky now that we're seeing much more volatile data. And paired with upward revisions, it's going to be important what type of revisions we see in the data this morning. The cadence of upward revisions, are they going to be coming in core services? Is more of it going to be in January and February? And March is still looking promising. And so that run rate going into April and May looks better set up for 0.2% on the month. But the bar is definitely higher. And as I mentioned, with the strong growth data, with jobs over 250,000 a month, the Fed has emphasized that the risk of going too soon seems much greater than the risk of being patient.
Which is a reason why some people who still believe in a rate cut cycle that begins mid-year are saying that maybe this Federal Reserve has some other things on its mind, like the Japanese yen. They care. They're concerned. They're central bankers to the world, and they want to prevent some type of volatility tied to a strong dollar. Do you believe that this Federal Reserve would be swayed by some of the international moves to just have some sort of adjustment, rate cut adjustment mid-year, even without an incredible improvement in the data?
We know that the Fed's dual mandate is maximum employment and inflation, and so they're going to be most focused on the incoming inflation data. Of course, they care about what's happening in the global economy to the extent that it impacts U.S. financial markets, and that could cause some nonlinearity or some disruption to the U.S. economy. So they're going to be taking global conditions into account, but the reality is that meeting to meeting, they're going to be much more focused on the incoming inflation data. And if they feel concerned that core services is much stickier than what they expected and they need more time to get inflation down to 2%, they're going to want to be more patient. Inflation is going to be top of mind over what's happening globally, unless we see some type of significant disruption to financial markets. We know that the Fed has been able to backstop what's happened in financial markets over the past couple of years without having to adjust their policy rate. But who's to say how big this disruption could be and if it could push the Fed to move rates quicker?
This feels much more like a European question. We typically talk about the importance of the FX channel to the price stability mandate in places like Europe, in the United Kingdom. Does the Fed need a stronger dollar? Sarah, how much heavy lifting does that do for them?
The Fed doesn't need a stronger dollar necessarily. I would say that the biggest thing that's probably impacting inflation and actually helping us is what's happening in China, right? The slower growth deflation cycle. And so we're importing stronger core goods prices from China, and that's actually helping us reach our mandate. But the FX channel, while it has some impact on U.S. inflation, it definitely does not have as large of an impact as in Europe or as in emerging markets. And that's one of the silver linings of the U.S. economy, is that we're fairly resilient and insulated to what's happening overseas unless there's some type of large shock.
Sarah, just quickly before you go, base case for you and the team, is it still July?
Base case is still July, with risks if the incoming data over the next 3 months is more volatile or significantly above that 0.2% threshold.
Okay, Sarah Wolf of Morgan Stanley. Sarah, great to catch up, as always. That data comes out at 8:30 Eastern Time, the last big data point going into the Federal Reserve decision next week. Donald Trump, the former president, lots of things to say about the FX market and the importance of a weaker US dollar. This from the Wall Street Journal this morning. I'll read you the lead paragraph from this story. Donald Trump's allies are quietly drafting proposals that would attempt to erode the Federal Reserve's independence if the former president wins a second term, in the midst of a deepening divide among his advisors over how aggressively to challenge the central bank's authority. What did you make of that?
So Donald Trump, the next Fed chair, is that essentially what we're looking at? That essentially he'd be able to weigh in on this? I'm not sure what to make of this, because on one hand, you have to wonder whether this is just sort of campaign rhetoric. I'm going to take control of everything and everything is going to be great under my watch, versus actual proposals to dismantle some of the main institutions that govern markets, economies, and social systems in the United States. Hard to know the answer. It seems like a lot of people dismiss a lot of what comes out of his administration and his campaign as just that, lip service.
Sure.
This isn't the first time, though, and this is the reason why a lot of people are saying September is going to be tough for the Federal Reserve to cut, because this is the type of rhetoric that's happening behind the scenes, in front of the scenes, and around the scenes at a time of deep political dissent.
You joke about the prospect of Donald Trump trying to set interest rates, okay? Wait for this. According to people familiar with the matter, the former president, the Trump administration officials, and other supporters of the presumptive GOP nominee have in recent months discussed a range of proposals, from incremental policy changes to a long-shot assertion that the president himself should play a role in setting interest rates. A small group of the president's allies, whose work is so secretive that even some prominent former Trump economic aides weren't aware of it, has produced a roughly 10-page document outlining a policy vision for the central bank.
You know what this policy vision looks like? The biggest Fed put you could ever imagine in your entire life, because that's what we saw from his previous administration.
I think Congress is going to have something to say about this, don't you?
I mean, this is the reason why I think a lot of people aren't taking it seriously. That said, I read this story last night, and I was looking at this and thinking to myself, people are going to dismiss this as so outlandish as to be unrealistic.
Yeah.
And yet this is one of the main presidential candidates talking about completely overhauling the Fed independence that a lot of people say has been held sacred. What implication does that have in the near term? I would say it just only makes the political discussion around the Fed and when it makes its decisions that much louder.
When Trump was in the White House, they used to call it the presidential put, not the Fed put. It was the presidential put. Anytime the market gapped lower, sort of heard a change of tone coming out of the White House. The problem with policies like this, and who knows how seriously we should take them. This is a report from the Wall Street Journal. You could be the judge of that. But the problem with initiatives like this, if you start to talk about them seriously, you introduce so much risk into markets that there is no put. It won't be able to support markets. In fact, you might have to hike even more to regain credibility. And we've seen example after that over the years of that, when central banks maybe sort of veer away from their core mandate.
Are you talking about a Liz Truss moment?
Not just talking the UK, think about Turkey.
Yeah, Turkey,
Erdogan,
sure.
think about how much Turkey's had to do in response to that. If he didn't get involved, where would policy be? I don't, of course, know the counterfactual, but obviously you've seen difficulty after difficulty with central banks that when they go in this direction, they end up having to hike more than they otherwise would.
And you wonder if this Federal Reserve isn't going to hike in September, even if they have a reason to, in order to avoid some sort of political interference accusations.
I'm sure lots of you have got thoughts on this. Write in, by all means. In the next hour of Bloomberg Surveillance, Emily Rowland of John Hancock, John Lieber of Eurasia Group, Mandeep Singh of Bloomberg Intelligence, and a brilliant Gershon Distenfeld of Alliance Bernstein. All of that coming up next.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zabe Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
pillars of this bull market are in place.
The winners are going to keep winning. The more profitable companies are going to make up a bigger percentage of the S&P 500.
We see more business formation, business dynamism. That's something that had been lacking.
Certainly the market is improving, and we see that, but it's not a hockey stick.
It's not a stock market, it's a market of stocks. That's even more true now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It is not a morning for the Bears. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance begins right now. Let's get straight to it. In the pre-market, outperforming, Alphabet absolutely flying. I was going through the numbers yesterday afternoon. It was difficult to find a miss. It was beat after beat on the top and bottom line. Throw in an extra $70 billion buyback, a dividend. Lisa, we're up by 12% in the pre-market.
Which raises this question, again, kind of to Dan Ives' point, how do you bet against a behemoth that has so much cash? They can do the CapEx, they can do the dividend, they can do the share buyback, and still have a fortress balance sheet at a time where their share move last night was akin to something like $250 billion. I mean, to me, it's sort of shocking.
Ad revenue good. Cloud revenue solid. Let's talk about what we didn't see from Meta. What was the big difference, Bramo? We talked about this with Dan Ives earlier. What was the difference between Meta coming out and saying, look, this is what we're spending, and Alphabet and Microsoft doing the same thing with two very different stock price reactions?
Wall Street has not bought the virtual reality headset story, period, full stop. Meta has not given it up. Their name is Meta for the metaverse. The metaverse never came to be in the same kind of way that they thought that it would. People are looking for them to give that up and just go in on what actually is becoming profitable. It is hard to understand why they're doubling down on something that Wall Street collectively has said, this isn't going to work. And that, I think, is a real big distinction.
Well, the tech trade this morning is working perfectly. Alphabet and Microsoft making up more than 10% of the S&P 500. Equity futures absolutely flying. That's the stock market. Need to talk about the bond market as well. So yesterday, two-year yield back through 5%, briefly, virtually there right now. 10-year yield through 470, so new highs for 2024, 468.78. We've got PCE out a little bit later. I want to bring you a quote from Citi's Andrew Hollenhorst, because I think this is the theme, Lisa, that you and I are both exploring this morning. What would it take? This is what Andrew has to say. We still think markets are mistaken in pricing out cuts entirely this year. Softer growth concerns will be a key factor in Fed consideration to cut, and Q1 GDP details show fading support from fiscal stimulus and softer goods spending. He believes, with the team over at Citi, that it wouldn't take much to reintroduce a conversation about rate cuts this year.
He's not alone. I would argue that actually is the consensus away from the Fed funds future market, because essentially you heard that from Christian Nolting. You're going to hear that from Gershon Distenfeld. You're going to hear that from a lot of guests who come on and still believe the rate cutting cycle will begin this year and possibly even get legs. It raises this question. Is there true weakness under the hood? And if so, is that supportive of risk assets, right? I mean, again, this sort of goes into the chicken or the egg. And again, I think that Bruce Kasman just nailed it when he wrote, that sound that you hear is the narrative breaking. And that essentially is how I feel this morning.
We'll hear Bruce a little bit later this morning talk a whole lot more about that theme. Broader price action, equities doing okay. You've seen bond yields. Let's talk about foreign exchange. Dollar yen at the moment, 156.83, positive by 0.75%. That is Japanese yen weakness on the screen, Bramo, this morning. And yen weakness that this BOJ is struggling to do anything about.
Okay, Mohammed El-Arian corrected me. So, Mohammed, this is for you. You said, actually, the Bank of Japan cares quite a bit about the yen. They're not just taking a whole benign neglect kind of approach. It just is unclear what they can do at this point unless they have some other type of weakening data from the United States. Again, this just raises a question, what's the breaking point to them? And Kit Jukes, I think, talking about 170 as a level, highlights just how much angst there is out there.
156.85 on the screen right now. New high for the session, for the month, for the year, for the last 4 decades. Coming up, Emily Rowland of John Hancock and Tech driving stocks higher. John Lieber of Eurasia as Secretary Blinken meets Xi in Beijing. And Gershon Distenfeld of AllianceBernstein looking for a rally in bonds. We begin with our top story this morning. Blockbuster tech earnings driving futures higher. Emily Rowland of John Hancock writing this. We have been married to tech stocks for years. It's been a successful relationship, but it may be time to date more cyclical parts of the market during this period of re-accelerating inflation growth. Emily, let's talk about why you want to cheat on something that is treating you so well this morning.
Well, after last night's earnings results, you know, the narrative has shifted a little bit. It almost feels like you're kind of married to Mr. Perfect here, right? You know, we know your company's doing great, earnings across tech and communications services coming in around 30 to 40%, but the stocks are starting to get a little flashy. We liked them more a few months ago when they were a bit more humble. So it's really about, you know, thinking about still owning these stocks. We're still in a relationship, but you might want to look around a little bit to see who's the next up and comer.
Are you saying there's red flags?
Not necessarily around the fundamentals. I mean, there's nothing wrong with tech. The earnings are great. It ranks really high on our quality metrics, things like return on equity. These companies have a ton of cash. It's just everybody's in love with them. Everybody wants to be married to them. So a lot of that's already been reflected in the price. We want to diversify away from that and own things that are actually trading on sale. And as the economy continues to chug along here, we think areas on the value complex, specifically the energy sector, deserves a look in portfolios.
If Mr. Perfect is Mr. Perfect, why leave him? I mean, honestly, you have to realize that at a certain point, if we're not going to get rate cuts, if it's not going to look better elsewhere, is it just sort of to see what else is out there for the sake of seeing what else is out there, but Mr. Perfect ultimately is the one to be with?
I got to be careful with this analogy to make sure my husband's not listening to it. But you know how these marriages go. After a little while, you guys know we've been married to tech for a long time, and we're going to continue to have that relationship. There's no doubt about it, especially given our preference for quality and given our preference for U.S. equities over international. We simply have the best earnings here in the United States, and a lot of that's been driven by tech. So it's not about abandoning the relationship. It's just about looking around a little bit to see what areas of the market actually have been left in the dust and might benefit from this modest reacceleration we're seeing in economic growth, in demand globally. And we think that on the value side, those stocks have been ignored.
I'm going to have to bite my tongue in taking this analogy further, so I will leave that there for now. I am curious, though, at what point this idea of diversification is really predicated on a rate-cutting cycle, even if it only is one that starts this year. Does that idea of diversification working fail if you get the idea of no rate cuts this year and potentially much higher rates for longer?
Yeah, I don't think so. I mean, the idea that we're looking at is that, we had this massive momentum Fed pivot party, driven rally, and really tech and growth were the biggest beneficiaries of that. At one point, the S&P 500 growth index was trading at a 45% premium to its long-term average. And really a lot of that was predicated on the idea that growth was slowing and that rates were going to get cut. The higher for longer narrative to us really speaks to the idea of diversification and seeing some participation from areas that really did not participate in that momentum-driven pivot party rally. So I think, if in a higher for longer environment, which it looks like we're here to stay, we do think that more cyclical areas deserve a look in portfolios.
Well, let's have a look at energy this morning. So Exxon came out with earnings in the last hour or so. EPS in at $2.06, the estimate $2.19. It's a small miss. The stock is a little bit lower in the pre-market. Is that where you want to be?
Yeah, we do think it looks like, energy can do well here. Those companies in general have a lot more capital discipline. For years, energy companies were just pumping more money into producing more oil, and now there's a lot more uses of that capital, whether it's capex, whether it's investment in, or whether it's producing dividends for investors. So we think, certainly the portfolio managers that we work with at John Hancock have done a great job being active in that space. And it's, feels like a little bit of a 2022 playbook right now with the stagflation narrative coming to the forefront. And of course, we know that energy was really the only winner that year in addition to the US dollar and cash. And we want to be mindful of that.
How much weight do you put on the stagflation narrative of yesterday?
I think it's, there's whiffs of it, John. Obviously the first reaction, and it felt like a roller coaster ride yesterday as everybody started digging further into the GDP data and deciding it wasn't really all that bad and inflation wasn't all that bad. I think that was the gut reaction. The missing piece to this, the twist on the stagflation argument is that the labor market is so resilient. Everyone was focused on GDP yesterday, but initial claims came in at 207,000. That is like the jobs market saying there's nothing to see here. Of course, the unemployment rate's still well below 4%. So the economy's doing okay. You look under the hood at GDP, final demand was really robust. Consumer and business spending still doing well. There were some pieces of the pie that weren't so great. The economy's chugging along here. So I think we're still not at stagflation yet, but there's kind of some whiffs in the air.
I'm trying to just imagine your investing life. So you're married to Mr. Perfect. You're dating the hot thing, which is commodities. How often do you go visit the parents, which is the bond market? I mean, basically, where does that fit in to this whole equation?
Yeah, so that we've continued to emphasize bonds and portfolios. The fact that you can get paid to wait in this never-ending late cycle environment to us is really attractive. We think we'll continue to see some chop in rates from here as we look at how long it's taking to get back down to the Fed's 2% target in inflation, growth picking up again modestly here. It's not great, but the fact that you can earn 5+% in income owning the aggregate bond index, that's something that we haven't been able to say in a really long time. So we think it makes sense to lean into bonds, get paid to wait, because this cycle likely ends the way that it always does, which something will break. It's just really hard to see that right now.
Lisa, who are the kids? Foreign exchange, the Japanese yen.
Bitcoin.
Where's this going? Bitcoin, crypto.
Yeah, NFTs.
Oh, you're going to make friends this morning.
Carry on. Well, I mean, I love it. Dating the hot thing, commodities. How long can that last? That's sort of what everybody loves.
He's too perfect.
I want to go into that.
Do you want to clean
further.
that up?
Yeah, exactly.
He's too perfect.
He's too perfect, which means what exactly? That why don't you want him to,
Men the world over want to know what is too perfect.
And honestly, and babysit, frankly, crypto.
Emily, we're going to go. Emily Rowland.
There you go.
John Hancock, this is your fault. Thank you. I like the parents as the bond market.
Well, I mean,
everyone in fixed income this morning agrees with you.
100%.
Because, everyone in fixed income looks down at every other asset class.
Totally, and tells them that they just don't understand. They need to get responsible and balance their books, understand their cash flow, and essentially, the stock market is saying, just live a little. Risk a little.
Sure.
Invest a little bit in the future.
We need an intervention in the FX market. This is what you do with the kids every now and again, right? Okay, this works. This isn't even a quiet news day. I don't know what we're doing. Equity futures right now on the S&P 500 up by 0.8%. Let's get you some of that news elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Testimony resumes this morning in the hush money trial of the former President Donald Trump. It's now the defense's turn to question former National Enquirer publisher David Pecker. He was the prosecution's first witness, during which he described helping to bury embarrassing stories Trump feared would hurt his campaign. Huawei's latest smartphone carries a version of a processor that had alarmed U.S. officials. It was revealed last year, during which that Washington thought the advanced made-in-China processor was beyond China's capabilities. Now, the U.S. is weighing additional sanctions to contain Huawei and China's chip industry more broadly. Now, as for the company itself, its new phone sold out within 2 days of its launch, according to checks done by Jefferies. Blackstone's head of credit and insurance sees a further slowdown coming for corporates, which means they're going to need extensions of loans as maturity walls approach. And he says Blackstone is ready to take advantage of it.
Certain companies will need a bit more runway, will need a bit more of an extension of, say, their first lien unitranche paper. They may need a piece of mezzanine debt or preferred security. So we're getting ready for that. I don't think you'll see a massive slowdown, but you'll see a slowing top line and bottom line that we've kind of started to see play out a little bit here.
Gilles Dillard spoke with me exclusively in his first interview since taking the role. And that's your Bloomberg Brief, John.
Danny, thank you. We'll catch up with Danny again in about 30 minutes' time. Just on the tech calendar, 2 dates for you. So Tuesday, you're going to hear from Amazon. 2 days later, Thursday, you will hear from Apple. That's the big focus for tech earnings, sandwiching a Federal Reserve decision on Wednesday. Up next on the program, Blinken breaking ground with China.
The United States is very clear-eyed about the challenges posed by the PRC and about our competing visions for the future. We want China's economy to grow, but the way China grows matters.
More on the conversation between the Secretary of State and the leader of China up next on the program, live from New York. Good morning.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Here's a picture of two names that make up roughly 10% of the S&P 500. This is what those two names are doing. Microsoft's up by more than 4%. Alphabet is flying by more than 12%. And when you put that together, you get this. Equity futures doing nicely on the S&P. Switch on the board. Futures look like this morning. S&P 500 futures up by more than 0.75%. Yields a little bit lower, down 2 basis points, 468.78, with economic data just around the corner. PCE, the Fed's preferred inflation gauge, at 8:30 Eastern Time. Under surveillance this morning, Blinken breaking ground with China.
The United States is very clear-eyed about the challenges posed by the PRC and about our competing visions for the future. In my discussions today, I reiterated our serious concern about the PRC providing components that are powering Russia's brutal war of aggression against Ukraine. I made clear that if China does not address this problem, we will. America's actions are not aimed at holding back China's development, nor are we decoupling our economies. We want China's economy to grow, but the way China grows matters.
Here's the latest. Secretary Blinken meeting with Chinese President Xi Jinping in Beijing. The two discussing everything from Russia to Iran, but not TikTok. Joining us now to discuss is John Lieber of Eurasia Group. John, of course, there was a meeting between the Secretary of State and the leader of China, also a meeting between the China Foreign Minister Wang Yi, who accused the US of taking endless measures to suppress China's economy. This was a conversation of more than 5 hours over a working lunch. John, do you think the United States has managed to get its point of view across, whereby the Chinese will change their mind about some of this language? It's not fair competition, but containment. It's not removing risks, but creating risks.
I mean, the language isn't really the problem here. You've got two countries that are clearly on a continued collision course, that are going to continue to be each other's antagonists, both in the economic sphere, but also the geopolitical sphere. So, you know, these kinds of conversations should probably be seen as positive just because they're happening. But the real issues here are what Blinken said in his speech just there, that the Chinese continue to support Russian material in its war against Ukraine, that they're buying this Iranian oil that the U.S. is okay with for now, but would probably prefer to get the Iranian oil off the market, particularly if Donald Trump comes back in. And you've got this ongoing threat of tech competition, which is sort of looming in the background of the relationship, where a lot of American companies are trying to decouple and divest away from China because of the increased threat they perceive, both in the operating environment in China, but also America's politicians' very hawkish turn towards China that could lead potentially to a sudden stop in relations at some point down the road.
John, let's sit on geopolitics then. The amount of influence that Beijing has over Iran, has over Russia, and the amount of influence the US has over China to do something about it. How much influence do both sides have?
I mean, the U.S.'s influence here comes in the form of sanctions. They could sanction Chinese entities that are buying Iranian oil. They could sanction more Chinese entities that are supplying dual-use goods to Russia. They're not yet, in order to preserve the relationship and maintain gas prices, but they have the powers to do so. I think the Chinese influence over those two countries matters, and there's probably quite a few things going on behind the scenes that we don't exactly know about in terms of how they're supporting Russia, how they're supporting Iran, potentially how they're supporting the regime in Venezuela. There's just things we don't know. And and that material support plus the strategic support probably helps those regimes counter American influence, which is in some ways helpful for the Chinese in their long-term goals.
John, how much do you think that this administration in China is more willing to work with President Biden because they prefer him over the alternative?
I think they've had a decent relationship with Biden, but it hasn't been all great. And if you look at the trajectory of the relationship under Biden compared to President Trump, it's largely the same. Biden did nothing to reduce the tariff complex that was created by the Trump administration, and he's gone significantly further than the Trump administration on cutting off Chinese access to U.S. semiconductors and other advanced technologies, and potentially is setting up to do even more in a second Biden administration. Now, the Trump administration is probably going to do a lot of that same stuff. So I sort of wonder from the Chinese perspective if they really care which of these men wins the White House in November. One thing the Biden administration has done a little bit differently has been a lot more multilateral. They've been able to align a lot of U.S. allies in favor of their initiatives. The Trump administration struggled to do that a little bit more, but we have now this precedent set where we've got this increasing kind of tech competition, this tech Cold War happening between these two countries that's likely to continue no matter who wins in November.
You know, we talk about TikTok. They didn't discuss it, and yet the specter kind of hangs over a lot of American businesses as well. When they try to figure out what kind of retaliation can they expect from Xi Jinping, from China, if there is some sort of TikTok ban or forced divestment. Do you see this as something that Xi Jinping is willing to do to really divorce the relationship between the United States businesses and China even more?
Well, on the issue of TikTok, to me, it's really interesting. The news yesterday indicates that ByteDance is willing to shut down TikTok operations in the U.S. if they're forced to divest because of the fact that that operation is such a small share of their overall profits. It's also interesting to note that the retaliation in many ways has already occurred. I mean, China has been harassing U.S. tech companies operating inside the country for years. You know, Google, Facebook, they don't really compete, if they're in there at all, on a level playing field. There is a threat for things like Apple's operation or Tesla or other big U.S. companies, but none of those really rise to the level of being geopolitically important to the United States. And what I would expect to see are further decoupling and further bans of individual companies in both countries in the coming months and years.
What do you make of the increased action in the South China Sea? The fact that people are talking about some potential incursion on Taiwan in the foreseeable future. Do you think that China has the appetite to do that at a time where its economy isn't growing as much as they'd like?
We think something happened on the Taiwanese, on the island of Taiwan is very unlikely. It just seems not like it's in China's interest to invade. It seems like they have a lot to lose. And if things go wrong, they're going to set themselves back significantly, both economically, but also diplomatically and geopolitically. However, there are a lot of sort of gray zone actions that they can take short of an actual incursion, including a blockade, which is not on the table right now, but that would be a significant challenge for Taiwan. They could also start doing more things to harass Taiwanese shipments going to the mainland or going to the United States, which could end up having a massive disruptive effect on commerce, even if the Chinese recognize what a huge mistake it would be to try to take Taiwan back by force right now.
This is a bigger question, I think, for the Europeans, John. I believe that someone notable was talking about this overnight. It might have been the NATO Secretary General, I forget, so forgive me. But comments about whether Europeans were making the same mistake with China that they made ultimately with Russia and relying too much on profits out of China. John, do they run that risk? And how big is that risk for the Europeans?
Absolutely. And look at who the leading edge is in both cases. It's Germany. So the Germans have done a lot of work in order to integrate their industrial base with China. China's an important market, and it's an important manufacturing hub for Germany as well. And you've got Olaf Scholz, who seems like he's out of step with the rest of the West and the rest of the Europeans in wanting to deepen and continue that relationship. So that's entirely possible. I actually think one of the interesting things coming out of a potential second Trump administration would be this alienation between the Europeans and the United States on the issue of China. But we could have very different political leadership in Germany in a couple of years that may change course here. So there's a big risk that they're running right now of getting too reliant on China and losing one of their most important trading and economic partners in the United States.
What a moment. John, just wonderful to catch up with you, sir. Thank you. John Lieber there of Eurasia Group, breaking down some of these issues. Question I wanted to ask you, Bramo, is basically how divided or united Europe is on this matter. When you hear from Scholz, do you hear something different from Macron?
I think the answer has been yes, pretty much across the board. And the question is just how alone is Germany at a time where they need it? Their economy is the sick man of Europe, right? This is what people are saying, as opposed to sort of the strong suit in the closet. I mean, this is the question. I know my analogies are just terrible today.
Long week, Bramo.
But it's really, to me, this is actually a really big deal, because how does Germany restart growth if they don't have China? And if they do have China, do they still have the United States down the line?
Yeah, the model's broken. Said it a few times, haven't we? It's very broken. Coming up on this program, something that's working. Shares of Alphabet and Microsoft absolutely flying in the pre-market. Blockbuster earnings report, driving these stocks higher by 4% on Microsoft, up more than 12% on Alphabet. We'll catch up with Mandeep Singh of Bloomberg Intelligence next.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases.
Another thing that startups need to look for
is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
For the last few weeks or so to suggest that they do. I think you're on the right line of things when you raised it earlier this week that ultimately, if you're a policymaker, what do you care most about? You care most about preserving credibility of an institution. And to your point earlier this week, if you come in and it doesn't work and you sacrifice credibility over that, if you can really think about the perfect time to come in and intervene, it would be if you got a downside surprise on US data, you had that dollar weakness kick through and you just slapped it down even more and really forced through a stronger Japanese yen. That would be the time to do it, to exacerbate the trend. I think going against this right now, just increasingly difficult, which would be, you know, why we've gone through 2, 3, 4, 5, 6, and we're looking at 157 and they haven't done anything yet.
So in 56 minutes and 30 seconds, just wait. If we do get a softer than expected PCE print, the core metric that the Fed likes to use to gauge inflation in the United States, watch for a very volatile move, in particular in the dollar-yen cross.
I'm not sure how much scope there is for a downside surprise on PCE, given that most economists sort of know, basically with the information we have so far, where that's going to land at 8:30, but sure.
Probably not, which, I mean, again, we used to keep wondering how high the bar is anyway, but, you know, keep talking about it.
That currency pair positive by 0.7%. I think we've all got it on our Bloomberg terminal, just sort of sat there staring at the chart every morning. A little under an hour away, we'll get a fresh dose of US inflation data with the core PCE deflator due at 8:30 Eastern Time. Traders watching closely for hints of stagflation after yesterday's GDP data trailed forecast. It's amazing how quickly everyone's talking about a different theme. Stagflation, a whisper of it after yesterday's data.
Basically, nobody was talking about the potential for any kind of weakness. I actually think that more than core PCE, personal income and personal spending is going to be more important, because that was the area that missed yesterday in the GDP numbers. If we see personal spending come in hot, well, all of a sudden stags out and we're back to no landing. And so all of a sudden we go back to this idea that you do have just pure strength with no asterisks around the edges. To me, that's going to be a bigger number.
Big moves in this market, pre-market. Let's talk about them. Microsoft and Alphabet rising big time. Both companies blowing past earnings estimates yesterday afternoon, fueled in part by booming use of artificial intelligence. Tech giants are jostling for dominance in AI, with Microsoft and Alphabet's results coming in stark contrast to what we saw Meta do in trading yesterday. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, you said it. These two are the big ones this week. Let's talk about the numbers. Can we start with Alphabet? Alphabet, earlier in the quarter, struggles. Gemini, screw up. Big challenge to the core part of this business. And here we are up by more than 10% of the pre-market. What's going on?
Yeah, I mean, the overhang from the Gemini screw-up has been cleared now, and they showed that in the search results. I mean, the 32% operating margin we saw in the quarter was driven mostly by search. Cloud and YouTube are great, $100 billion combined businesses growing at almost mid-25%. So you could argue, you could give it a $1 trillion market cap just for those two businesses. And search, I mean, for a company like Google with a $200 billion business that they can grow at mid-teens, that tells you incremental margin of 75% in search. That tells you something, how much pricing power they have. And that's what they are doing now, flexing that muscle.
Let's go to CapEx. I think they doubled it. They doubled CapEx from last year, which is pretty amazing.
Yeah. And look, I think what they're doing is they're using that CapEx to grow the cloud business. So the difference between Meta boosting their CapEx versus Alphabet is pretty much using that CapEx for cloud capacity. That's showing up in the numbers. Cloud business actually accelerated to 28%. And what we learned from Microsoft is AI services, the cloud component where they run the infrastructure, actually contributed 7 percentage points to growth. So it's pretty similar to Alphabet, although they didn't break it out, and that just shows you how much power they have.
This is a big move of more than 10%. Lisa was talking about at one point it being an extra $250 billion on the market cap, which when you think about it is kind of ridiculous. I mean, seriously, do you think there are trends here that we can extrapolate out beyond the next quarter, beyond the quarter after that, into the next few years?
I mean, this is probably a one-time move. I think it was right there in terms of everyone to see how much power they have with the three independent businesses. And I would argue even Waymo. It's an optionality in their portfolio. If robotaxis is a thing with Elon Musk when he launches in August, Waymo is far ahead in terms of the autonomous fleet, even though they don't have as many cars. And I would argue that business is worth a lot as well. So clearly, with Alphabet, when you look at the sum of the parts, I mean, Alphabet plus YouTube $1 trillion and Score Search at least more than $1 trillion in market cap, Waymo optionality, this business was undervalued for sure.
You talk about $1 trillion here, $1 trillion there, all of a sudden you're talking about real money. Are they just making money outright that wasn't to be made elsewhere? Or are they taking share from, say, AWS of Amazon?
I think on the cloud side, given the numbers we saw from Microsoft with 31% Azure growth and Google growing 28%, Amazon has a $97 billion run rate in cloud. It's the largest cloud player, and it was growing at low teens. So if they don't show that kind of acceleration where they are close to 20%, they're probably losing share right now, and for good reasons. They don't have the NVIDIA GPUs to deploy on their cloud. So that's part of the reason. They don't have their own foundational model. They are partnering, and that's where I think the market needs more clarity.
If the market gets the clarity that confirms your suspicion, how violent could this move be, given the fact that the AWS platform has been the profit driver for Amazon?
Yeah, and ads as well. So ads is another $50 billion business that Amazon has been able to really curate over the last few years. And ad side actually may do quite well, given what we saw from Meta and Google search. I mean, Amazon is quite formidable with Google, with their own search, and they don't have the Chinese advertiser exposure that we were talking about with Meta, to an extent with Google, less so. Amazon doesn't have any of that. It's all the small businesses that advertise on Amazon. So the ad side may be better than the cloud side, but clearly, to your point, cloud is the bigger business. It's a profit driver. And if the growth doesn't accelerate, I think that may be an overhang on the stock.
Do you sense any e-commerce fatigue over at Amazon? I feel like attitudes towards that side of the business are shifting pretty quickly.
Well, so on the e-commerce side, what they're doing is really making the Prime bundle kind of indispensable. They're adding more services. They're adding grocery delivery now. So they're really making that sticky. And that's always been Amazon's playbook in terms of driving recurring subscription revenue.
I hate buying clothes on Amazon. I've got to be honest.
I think people are starting to hate buying everything on Amazon.
Yeah, well, it's sort of frustrating if you don't get exactly what you want. They want the experience of existing in this real physical world.
You pay for Prime, and now it's sort of like you have to pay extra for Prime Video for no ads. You didn't have to used to do that. And now I think, did I hear earlier this week there's going to be a new thing you have to pay for delivery through the year when you already pay for Prime? I don't understand that either.
All of this they can work through. I am wondering.
It's the one bundle you can't get rid of. That's their play. You can just get rid of all the other subscriptions.
Haven't everyone else upped their e-commerce game to such an extent that maybe you could live without it now? Aren't we getting closer to that?
Well, again, that's why they package so many features. Video, part of giving you video and grocery delivery and e-commerce and all sorts of other things is that is the one bundle. If you have to really cut back, cut on your one-off subscriptions. You can't get rid of your Amazon bundle.
Dan Ives was on earlier, and he was saying with all the tech names, what he's watching for the next iteration is acquisitions. And he thinks that the likes of Google and Microsoft are really going to amp up that engine. I don't know about Amazon. They've already done that quite a bit. Do you see that as possible, given the environment we're currently in?
Very unlikely, unless, TikTok, which is up for sale, can be bought by, let's say, a Google. I mean, Google obviously doesn't have its own social media, like YouTube is the closest that comes. And maybe that's a potential acquisition if the regulators let it happen. But I don't think that will fly.
Well, that's what I was going to ask. Yeah. I mean, how much can this be a base case? And if they don't do that, what do they do with their fortress of cash? Just T-bills and chill?
And they announce a dividend. So now the focus will be on Amazon announcing a dividend because that's the only one among the Mag 6 not to have a dividend. So I think next week you probably are, again...
What do you make of the maturing of these companies offering dividends? Things like Alphabet. What do you make of that? How important is that?
I mean, when you're generating 80 to 90 billion in free cash flow, buybacks, yes, you can do that when you want to do that. But having a dividend just attracts more long-term shareholders, different kind of shareholders, and it's more symbolic. I mean, the dividend yield is less than 1%, so it's not as if they are right up there with other sectors.
I always think about some of these companies, they're so big now. What is Google doing owning Waymo? Why do they own that? Why don't they just sell that?
Because their argument is AI is everywhere, and that's what they're doing, infusing AI in all their products, whether it's search, cloud, YouTube, Waymo.
It's all the data. It's all the data. They're collecting data on every aspect of our lives, and the more data they can really collect and own, the more their artificial intelligence models are going to be best.
The social media platform, just call up Elon and do a swap, Waymo for a Twitter. I'm not sure one is worth the other. But
is that really?
Maybe he's using X for Tesla's AI.
Hey, possibly. Making deals this morning, Mandeep. Mandeep Singh there of Bloomberg Intelligence. Deals, as we know, that with this administration will not go through anyway. So it's a sort of a fruitless conversation. Equity futures right now on this S&P, positive by 0.7%. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Testimony resumes this morning in the hush money trial of the former President Donald Trump. Now it's the defense's turn to question the former National Enquirer publisher David Pecker. He was the prosecution's first witness and described helping to bury embarrassing stories that Trump feared would hurt his campaign. The FTC is alleging that Amazon founder Jeff Bezos, CEO Andy Jassy, and other senior leaders destroyed business-related text messages. The FTC said that between April 2019 and May 2022, they texted using Signal with a disappearing message function. The filing also expands from other antitrust allegations from last fall. An Amazon spokesperson called the FTC's allegations, quote, baseless. BHP's bid for Anglo is rippling through copper markets. The metal hit $10,000 a ton, just backing off of that now, but for the first time in 2 years. That deal underscores supply issues among the metal, that miners would rather buy a rival than build entirely new projects. BMO's Colin Hamilton said that it tells you building the stuff is just too expensive, while Blackstone says that prices need to hit $12,000 before new mines make sense to be built. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate the update. We'll catch up with Danny again in about 30 minutes' time. Up next on the program, the case for buying bonds.
At the end of the day, the yield is what matters. The yield is what wins. And yield remaining high, I think, really continues to act as a tailwind for the bond market.
We'll catch up with one of our favorites next, Gershon Distenfeld of AB, just around the corner.
I'm
Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Equities positive by 0.75% on the S&P 500. There is a lift in this market. We are about 43 minutes away from economic data in America. Yields are lower by 2 basis points. The 10-year, 468.37. Under surveillance this morning, the case for buying bonds.
Rates being higher is the story here. If you rewind the clock, January, November last year, there was so much bullishness around rate cuts, and I actually felt that was really the worst thing from the bond market perspective, as I think ultimately at the end of the day, the yield is what matters. The yield is what wins, and yield remaining high, I think, really continues to act as a tailwind for the bond market.
Here's the latest this morning. Yields near year-to-date highs after economic data pushed back expectations for Fed rate cuts. Gershon Distenfeld of AllianceBernstein writing this: investors are getting a second chance to, quote, not miss the rally in fixed income. At some point later this year, the markets will again become convinced that the Fed is going to start to cut, and we will, in all likelihood, have another very sharp rally in yields. Gershon now joins us for more. Gershon, wonderful to catch up with you. It's a second chance. The first chance expired in October. Can you talk to me about how different this moment is compared to that moment just several months ago?
I actually don't think it's that different, John, though. I have to point out something. About a half hour ago, you made fun of fixed income investors. You said that we think that we know more than other investors. we don't think it, John. We know it to be true. It's just a fact. Accept it.
You can answer the question now. With that said,
yes,
I'm on board. I understand. No argument here.
Yeah, I actually don't think it's that different. History suggests that the yield starts to rally. Actually, bonds of all stripes have very strong returns about 3 to 6 months before the Fed starts cutting rates. You have to remember, back in November, the market was convinced the Fed was going to start to cut around now. We obviously know there are good reasons why they're not going to. I can't tell you whether they're going to start to cut in September, December, or sometime in 2025. I think those are all possibilities. But at some point, we always focus on the latest data. At some point, the market's going to recognize you can't keep rates up here forever. The Fed's going to start to cut, and you're going to have a massive rally. Only 3 months ago, we were answering questions from investors. Did we miss the fixed income rally? And we kind of had to say, yeah, you probably did miss a lot of it, maybe all of it. And investors now are getting a second chance.
Gershon, something you view that I think is really interesting, your perspective on market pricing. When you look at market pricing for Fed funds, you call it an average of everything. That's the way you look at this. And we often sit here in the media, and I think a lot of people in markets are guilty of the same thing. They'll say, we're now pricing in just one cut from the Federal Reserve. And you say that's not what this is. It's an average of everything. And you think the average of everything right now is actually the least likely outcome. Can you explain that a little bit more?
Yeah, let's start with a year ago, right? A year ago, the market was pricing in 3 or 4 cuts by now, and we've gotten 0. Does that mean the market was wrong? Not necessarily. There was some chance that things would weaken considerably, and you would have gotten, 6, 7, 8 cuts by now. Or there was some chance, as actually happened, that inflation would be sticky and the Fed wouldn't cut at all. I think it's the same thing going forward. I would expect, 1 to 2 cuts is probably a very unlikely scenario. Either, right, the data will get, the economic data will get quite a bit worse, and inflation will be whatever it is, but the Fed will feel like we just have to cut, and they'll cut 4, 5, 6 times. Or, right, inflation will be sticky, economy will be fine, and the Fed will just hold off until 2025. I think those 2 tails are actually more likely than that 7.
If you love treasuries because you believe in the weakening tail, can you love credit?
Yeah, I think you can love both. Spreads are tight in credit, but they're justifiably tight. As I've said before in this show, our companies have spent the past 3 or 4 years post-COVID, paying down debt. Leverage has come down. They weren't making a ton of acquisitions or buying back shares or spending on capital expenditures. So companies are actually in pretty good shape. And the quality of the credit market, particularly the U.S. high yield market, has never been better. Many more double Bs, many fewer triple Cs. And that's relevant because almost all defaults, almost 80% come from triple Cs. So tight spreads are justified. And as my esteemed friend, Greg Peters, said that you had at the outset there, yields matter. Yields matter a lot. Yields matter a lot more than spreads. You could have spreads widen, as we expect they might as Treasury yields come down, but still have very, very strong returns. So we'd be advocates kind of all levels of fixed income right now, Treasuries and credit.
Have you noticed a different type of buyer coming into the fixed income market as suddenly yield does matter, and suddenly people are realizing they might have a sure bet on a 6, 7, 8% return than they did in equities? It's sort of a reverse of what we saw for so many years.
Yeah, Lisa, I think, look, I'm not an equity expert, even though, as I said, I know more than the equity people. That's a joke.
Thank you.
Most equity strategists are telling you you're not going to get the 10, 11% you've got in the start, but you should more like 6 to 8%, and credit's going to be very competitive with that. Starting with an 8% yield, I think even if you have the historical loss rate of 2%, that still gets you 6. We think it's going to be a little bit lower. We think 6 to 7 is probably the right level. The one thing that high yield and credit is very consistent on is in down markets, it goes down a lot less than equities. I come across people sometimes, they'll tell me, I'm scared of high yield, whatever. Defaults are going up, tight spreads, liquidity, whatever reason they come up with. And I said, okay, well, what % of your portfolio do you have in equities? And the answer, of course, is always, 50, 60, 70. And I very politely say, I just want to inform you that historically speaking, every time high yield has sold off meaningfully, equities have sold off more. When I say every time, high yield has had a drawdown of 5% or more 20 times in the past 40 years. So about every other year. Every single time, without exception, during that drawdown, equities did worse. S&P, MSCI World, whatever you want to look at. Now, is it possible? We should all be the first to say that things that have not happened in markets can happen in markets and do happen. Is there a scenario where equities do well and credit does poorly? I'm sure there's a scenario, but it's probably not a very good investment strategy to bet against something that's literally never happened. So I think investors should stop thinking about high yield as a way to take up the risk in your fixed income portfolio, look at it more holistically, and maybe take some chips off the equity side, which you've done really well in, put it into high yield, definitely reduce your risk and downside, and maybe not even give up return.
So that's an argument for resilience, putting more resilience into the portfolio, Gershon. When you make that argument, are they open to it?
I think it's difficult for a lot of investors because it depends on the type of institution, but a lot are very segregated among high yield and fixed income. I sit on the investment committee of a nonprofit, and I've made some inroads there, even though I'm on the fixed income subcommittee. But we find many investors still segregate things. That's the reason, by the way, that high yield has about the best Sharpe ratio of any asset class there is. In fact, people don't recognize this. I'm not suggesting this is really practical, but had you levered high yield to the same risk level of equities over the past 40 years, you actually would have had a higher return. So I think people under-allocate to high yield specifically because they look at it in that fixed income lens. And to invest in high yield, they're like, wait, why do I have fixed income? It's to protect me to do well when equities are selling off. And you start saying, okay, put some high yield in there, and all of a sudden, well, wait a second. That doesn't do so well when equities sell off. I don't want that in my portfolio. Where I think the right way to look at it, but to your point, it's hard for many institutions to do that, is to look at the entire portfolio and realize that high yield really acts more as a low volatility equity service.
Gershon, just quickly here, we just have about a minute. What about the other tail, the idea of not cutting rates at all? What does that do to this thesis?
It just prolongs it. You know, I have a hard time, you know, obviously if the 10-year got to 5%, it wouldn't shock me. But if I look very simplistically, right, inflation, you know, the Fed wants to get to 2%. The market's coming around to saying, you know, look, 30-year tips break-evens are about 2.4. We've long thought 2.5 just because of some of the secular trends of deglobalization, rise of populism. So you get to 2.5 on long-term inflation. And real rates have averaged 175 basis points over the past century. So I'm a very simple person. My simple math, 2.5 plus 1 3/4 is 4 1/4. And by the way, if you expect a slowdown, as we kind of do, you know, that should come in a little bit, maybe more towards 4%. So I don't know how we get there, but I do look out a couple years from now and see, you know, Fed funds will be somewhere around 3. You'll have a normal 2s10 slope about 100, and that'll put like the longer end of the curve around 4%. So I don't know what's going to happen in the next 2 months, but in the next year or two, yields are going to go lower.
Gershon, love this. Fixed income defender, Gershon Distenfelder, co-head of fixed income at AP. Gershon, good to catch up, buddy. Thank you. The amount of people in bonds that wrote in as soon as Gershon started that ran. Long live bonds. Kevin Giddish, remember Kevin? Happy birthday, Kevin. Thanks for writing in. Kevin writes in, long live bonds. I think everyone in the bond market feels that way about their asset class.
The parents of the room are saying, actually, we're the star. Finally, you can come back and appreciate who we are as people.
We're the smart ones, isn't that it?
We're the smart ones, and we can provide you excitement.
Sure, great. Can you? From New York, the third hour of Bloomberg Surveillance. Up next.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Disc.
My general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I played drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. but there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Hard place. This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes away from economic data in America. The third hour of Bloomberg Surveillance begins right now. Good morning. Good morning to you all. New highs for 2024 in the bond market. Let's get straight to that bond market this morning. On a 2-year, on a 10-year. Yesterday, back through 5% at the front end of the curve. On a 10-year, through 470. Back now by 2 basis points to 468.16. On a 2-year, 499.54. Bramo, the data, 29 minutes away.
And what's going to be more important? Core PCE deflator, which is the key inflation metric that the Federal Reserve looks at to make its decision-making, or personal income and spending. After yesterday's GDP print called into question the strength of the American consumer, do they reprise that strength in a newfound sense of ongoing consumption?
Yields have been high, the dollar's been stronger, it's been problematic for pretty much everybody, including the Japanese. Japanese officials grappling with this one today. Dollar yen looking at 157. You heard me right. If you've been away for a few weeks and you're coming back into this market, we're not talking about 152 anymore. 3, 4, or 5. We're through 6 and we're looking at 157. Session highs, Bramo, 156. 87 on dollar yen, and not a peep out of the BOJ this morning.
That was the biggest surprise. The fact that we're looking at these levels, which were thought of as unheard of way through the intervention points of yore, and suddenly you have the Bank of Japan basically not wholesale dismissing it, but saying that their job is not to support the yen wholesale, and it's not necessarily their main focus right now. What can they do then if it's not a Bank of Japan rate hike? A lot of people say they're waiting for maybe this core PCE number to come out softer than expected, or waiting for some kind of better intervention point. That said, I think that, again, we keep going back to this. Kit Juke's talking about 170 as a level, just because it's unclear what can break this trend if the Bank of Japan is going to remain on the sidelines.
The Federal Reserve decision next Wednesday. We'll have payrolls as well a week today. We've got PCE this morning. Plenty of opportunities just to reprice this market all over again. But let me tell you this, a company that doesn't need rate cuts, doesn't need a weaker dollar, it's Alphabet. Alphabet doesn't need any of that because apparently it's got a whole lot more. It's got a $70 billion buyback in the mix, an additional $70 billion yesterday. It's got a beat on the top and bottom line. Bramo, a ton of capex that no one cares about because it's going to be spending on the right things. We're up by 11.5% in the pre-market.
So we started the show with this, but I think it's worth repeating. Their market cap last night gained $250 billion. That is more than a McDonald's. They tacked a McDonald's onto Google. Then you add on top of that what we saw from Microsoft, which is essentially an implied $150 billion move. Walmart's market cap is $485 billion. They basically almost added a Walmart overnight to these two companies, just to give you a sense of the scope and scale. So when people start worrying about capital expenditure and share buybacks and dividends, it takes on a new meaning when you're talking about entire government of big tech prowess and promise, which is essentially what we're talking about here.
Should we go through the Max 7 then so far this week? So
Please.
Tesla said the right thing, stock higher. Meta said the wrong thing, stock lower. Alphabet couldn't say anything wrong at all. That stock is absolutely ripping. We've got Microsoft positive too. Into next week, Amazon Tuesday, Apple Thursday, NVIDIA later on in May. How are you thinking about those two names next week?
I'm actually more interested right at this very moment in Amazon, because are they losing cloud share? If they are, what does that mean for just how big of a share response you could see? With Apple, it's more interesting from a geopolitics standpoint, how much they're adjusting to the new intensification of the tensions between the U.S. and China. They also have a real question around some of the demand for smartphones, but it's a completely different story than cloud spend and this question of adoption of artificial intelligence on a broad scale.
And we understand based on reports that they are losing market share, particularly in one of their biggest markets in China. Had plenty of reports on that over the last few weeks. Live from New York then, equity futures positive by 0.75% on the S&P 500. Let's turn to the broader markets together. Bond yields pulling back just a touch on a 10-year, backing away from 470, 467.95. And the euro, negative, dollar stronger today, 107.15, going into that data about 30 minutes away. Coming up is Troy Gayeski of FS Investments on why a recession isn't happening anytime soon. We'll speak to Michael Pond of Barclays, counting down to inflation data, and JP Morgan's Bruce Kasman on why Q1 surprises were a bump in the road. We begin with our top story, the Fed's preferred inflation read about 25 minutes away. Troy Gayeski of FS Investments saying this: it's hard to see what negative force would be powerful enough to crack the labor market to the point where the US economy rolls over into a recession. Troy joins us now for more. So Troy, if you are constructive on the economy, if you struggle to see reasons why the labor market breaks and the economy rolls over, how constructive are you on this market right now?
Well, from an equity market perspective, John?
Yes, sir.
Yeah. So for equities, I mean, look, the concern for equities up until really 21 and early 22 was not the earnings power. It was multiples, right? And so we had a big period of multiple compression in 22. We've re-expanded back to 20 to 21. So we're very confident that there'll be earnings growth. I think the question is, if you get the 10-year treasury yield up to 5 or 5.25, will you see another round of multiple compression? Not back to 15.75, but maybe somewhere between 18 to 19. So the risk for equities now is less about earnings and more about valuations. But to what you were just discussing, I mean, mega cap tech just continues to crush it on basically every angle. And so I'm very sympathetic to the argument now, given the market cap constituency, that multiples should be more permanently elevated around that 20 number. So we'd expect more volatility going forward, but nothing as problematic as we saw in 22. And we've already run through a mild correction so far.
We just spoke to Gershon Distenfeld of AllianceBernstein, and he said in the bond market right now, these prices, these yields, this is your second chance. You had a chance, a big one back in October. If you missed it, you get a second bite. Buy this now. Troy, is he right?
Well, I've never met a bond market participant that's not bullish on bonds, right? Regardless of yield. But obviously yields are much more attractive today than they were coming into the year, and certainly where they were at the end of 21. Our main point on fixed income, though, is because we continue to have stronger economic growth, which in turn is leading to a resurgence, particularly in super core inflation, where you strip out owner's equivalent rent, energy services. Those numbers look really, really bad for the Fed right now. You have to be realistic that if you leg in now, you could have 3, 4, 5 months of mark-to-market pain. And when you think about a normalized yield curve, a Fed that might not hike at all this year, where should the 10-year be if we can continue to avoid recession and inflation numbers coming hot? So risk-reward is much, much better than it was coming into the year. But you still have to be cautious not to get over your skis. And we've seen a lot of that behavior, John, the last 2.5 years. Every time yields pop up, hey, let's buy fixed income rallies back. Then you have some bad inflation data driven by strong economic growth. You get a bear steepener. And it's almost been a rinse repeat. Whereas the flip side for equities has been, you have multiple compression because yields pop up, then earnings come out, and the earnings come out extremely strong, and then equities rally back.
So we were talking earlier about big tech being Mr. Perfect and the bond market being the parents warning about, needing to get life insurance. You just said something that are basically, we're fighting words. I've never met a bond participant that's not bullish on bonds. Does that mean that you are bearish on bonds? And just how bearish when you talk about where should the 10-year yield be?
Yes, fighting words is a strong term. I just watched, from the trenches the last 2.5 years, every time yields pop, time to get long duration, and that's led to some chagrin with clients. But, I think effectively, we're in the right range, that 4.5% to 5% range. But think about where inflation data continues to come out with a softer economy than we saw last year. So it's entirely possible that we breach the recent highs of 5% and go slightly higher, which again, it's not the end of the world. It just means you have to be prepared for that. And then the flip side is if the Fed starts to cut, say late this year or early next year, they're going to go at a very, very slow pace. And it's very easy to understand how the curve just twists, meaning the front end drops, but the back end doesn't drop at all. So you're going to earn at least your income, but you're not going to get the mark-to-market upside that a lot of bond market participants have expected and continue to expect.
So why not just be complacent? Own some of the big tech, own some T-bills, just rely on the fact that you're getting good income and sit there and be happy.
Yeah, I think you should never overreact, right? And I think right now the biggest challenge for investors is what to do with that massive cash pile they have. And in some cases, they're nibbling on duration. Didn't go so well late last year. On the other side, they're adding a little bit of equity risk. So far, so good this year, particularly, if you've timed your entry points well. And then, of course, the other side of that is to start adding to alternatives where you can increase return meaningfully, but not take uncomfortable levels of risk or uncomfortable levels of volatility. There's no reason to ever overreact in asset allocation, but incremental changes add up over time. And that's one of the key challenges today is how to deploy those massive cash forwards without taking uncomfortable levels of risk and still meaningfully increasing your return.
So we've been hearing this a lot over the past couple of years, Troy, the sort of allocation to alternatives, and we hear about private credit, we hear about other types of asset-based lending, asset-backed securities, a whole host of different strategies. At what point do we understand the valuations there? It's a less transparent market, and it seems like a lot of people have been plowing in.
Yeah, so I think there obviously has been substantial growth in private credit. A lot of that is just driven by the growth in private equity over the last 10, 20 years. When you think about the trend in markets, it's really, one of the reasons you have all this concentration in mega cap tech is more and more companies are deciding to stay private. So every dollar of private equity that's invested needs a dollar of private debt. In terms of market environment, look, as private lenders, we've been rooting for the Fed to hike as much as humanly possible and keep rates as high for as long as possible without cratering the U.S. economy. And here we are, right? And so when we look forward, the stronger economy means less of a hangover from a default cycle, which many people feared, including us, by the way, in 2022, and you're earning more and more income. So it's a great environment to be a private lender as long as you have dry powder to lend into this environment.
Troy complaining about bond guys talking their book, and then he talks his book straight afterwards. Troy, go away.
Hey, I can talk our book too, right?
I know you can. Troy Gajewski of FS Investments. Troy, thank you, sir. Appreciate it. Equities right now, positive by 0.7%. Least of the data, 18 minutes away.
And how big is the coiled response going to be? I mean, to me, the fact that we've seen such massive moves on not that significant data in terms of surprises one way or another just highlights how it's sort of hard to get ahead of this at a time when people are ready to go and change that narrative.
At the index level and on single names as well. I mean, you've seen that all week for the likes of Tesla, Meta, and Alphabet in various directions. Let's get you an update on stories elsewhere. We can do that with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Let's get you a quick check on Microsoft and Alphabet after big earnings beats yesterday, a 4% rise and 11.7 for Alphabet. By the way, if Alphabet manages to hold on to that near 12% gain, it will surpass NVIDIA's market cap today. Bank of America's Michael Hartnett flagged that record mega cap concentration in his note this morning, but said it will persist until real yields hit 2.5% to 3%, or when higher yields and spreads threaten a recession. Remy Contreau reported recovering demand for pricey cognac in China, but that still wasn't enough to make up for a brutal downturn in the U.S. Jefferies' Edward Mundy said that there's low visibility on when a recovery might come. It's a similar pain that other premium alcohol makers are facing. Pernod Ricard CEO yesterday said there's increased momentum everywhere except for China and the U.S. Now, according to the Wall Street Journal, Donald Trump's allies have drawn up plans to give Trump a say in monetary policy. The plan would have the president consulted on interest rate decisions and give him the authority to remove Jay Powell before his term ends. Trump has long professed his preference for lower rates. The concern among some is that political interference would force aggressive cuts at a time of still elevated inflation, possibly raising long-term rates as the government rolls over trillions of dollars of debt annually. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. We'll catch up with Danny again in about 30 minutes' time. Fascinated by this story. So this is according to people familiar with the matter. It is Wall Street Journal reporting. They have produced a roughly 10-page document outlining a policy vision for the central bank. I would love to hear from the former president, who's a bit tied up this week, I know, with other things. I'd love to hear him talk directly about what this is about.
How seriously they're going to take this. You've raised the specter of Turkey before, and potentially even of having to raise rates further to support the dollar if you start questioning the Fed independence. it's so hard to know what to take seriously and what to not. And this is something I know market participants are struggling with as well.
It's a question for Michael McKee in the news conference next week. I'm sure Chairman Powell's got lots to say on the record about that.
Yeah,
no,
like what?
I think he's going to avoid that at all costs. Up next on the program, inflation data on deck.
The market needs to see a couple of good prints on the data. You need to see probably 2 to 3 good inflation prints, whether PCE or CPI. And that probably, I would say, takes another 3 to 4 months minimum.
What would it take to reintroduce a conversation about rate cuts in America? How small would the data surprise need to be? That conversation's up next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Very focused on the inflation data, I promise you, but also got one eye on the Red Bull design chief, Adrian Newey, reportedly set to leave Red Bull and potentially going to Ferrari, which for Ferrari fans would be absolutely massive.
If you were on set with Tom right now, we wouldn't even be covering core PCE.
No, we wouldn't. We'd be covering
yes,
that.
and we'd be talking about design.
How successful is Newey?
Yeah.
How dependent are Red Bull on him because he designs the car and
Right.
that's where the success comes from? And
Or is it?
could it change things for Ferrari and Lewis Hamilton when he joins next season?
Not that you'd rather talk about that.
No, I'd
Not at
much
all.
rather talk about inflation,
Clearly.
which is 13 minutes away. Equity futures right now going into that on the S&P 500. This is sport to me as well. This is like, you know, I love
Just as
markets
good?
as much as I love Formula One and football.
This is like Red Bull design.
Absolutely. The design chief, like, I'm less interested in Formula One and football. Like, these are the scores that matter to me.
Okay, literally, the more you talk, the worse it's getting.
These
Carry
are the
on.
scores that matter to me.
Move on.
We're down 2 basis points on a 10-year, 468.37. Under surveillance this morning, inflation data on deck.
The market needs to see a couple of good prints on the data. And we keep telling people it's a market of catalysts, not levels. So you need to see probably 2 to 3 good inflation prints, whether PCE or CPI. And that probably, I would say, takes another 3 to 4 months minimum and could be into next year.
Here's the latest this morning. The Fed's preferred inflation read due in 15 minutes' time. The median estimate in Bloomberg's survey calling for a 2.7% increase from a year ago. Michael Pond of Barclays saying this: regardless of how one slices and dices inflation, just isn't showing signs of further moderation. Despite the strength of inflation itself, the inflation market continues to price in a return to the Fed's target quite soon. Michael joins us now for more. Michael, let's start with the story, and then we can get into the price of the story. What are you expecting to see in about 12 minutes' time?
Well, usually when we go into core PCE, we already know what it's going to print because we know it from the CPI and the PPI earlier in this month. But this time around, yesterday's number threw a wrench in the story here because we got an upside surprise to the quarterly number. We're not exactly sure how that's going to play out versus the revisions in January and February. But if all of the surprise from yesterday came through in this morning's core PCE number, it would round up to 0.5. That is not only above the Fed's forecast, that is dramatically above. And you know, if we kept seeing prints like this, we would start to be talking about hikes.
Michael, where exactly did that upside surprise from yesterday come from?
Well, we'll have to see. We don't know the real details when it comes to the inflation print from yesterday. So that's why the monthly inflation print will be really interesting, whereas usually is just, you know, a confirmation of what we already know. So we'll be looking at the spread between the monthly prints, how much January and February get revised, or is it all in March? And then what are the details? Is it components that we can throw out and just say, yeah, more bumps in the road, or no, this is real, inflation really isn't going down and the Fed needs to pay attention?
Michael, how much credence do you give this idea that it's just auto insurance and it's a one-time pop, that we see some sort of misvaluation of rents, especially given the fact that you have seen stability in certain markets, and that generally, from what you hear from earnings, there is a sensitivity to pricing by consumers?
Lisa, if you strip out everything in inflation that's not 2%, guess what? You get 2%. I think too many people over-massage the data to try to fit their view. The bottom line is that core goods inflation is near zero, but it's been near zero for a while. That's not going down further. Shelter inflation has stalled, so it's come down from its highs, but that's not going down. And super core, the core services ex-shelter, also has stopped coming down. So regardless of which part of inflation you look at, you can slice and dice it to get the answer you're looking for. But if you're honest, inflation just has stopped going down. It's stalled at a level that's uncomfortable for the Fed when it comes to potential cuts.
Michael, you've studied inflation for decades, and this has been one of the key sort of debates about what's driving it and how sustainable it is, and whether rate hikes will actually help curtail it or whether actually rate cuts could help curtail it. Do you give any kind of credibility to this argument that higher rates are actually helping to fuel inflation by keeping the housing market stagnant and by giving certain people with savings extra cash to keep spending?
So not overall. There are certainly components of inflation that are sticky because of high rates. So you just mentioned housing. So the extent that potential home buyers can't buy a house because inventory is stuck, those who have low rate mortgages don't want to sell their house. They want to keep that low rate mortgage. And it's difficult to buy a house when mortgage rates are so high. That leaves more single family renters. So rent inflation remains strong because housing market activity is weak. That's pushing up on shelter inflation. But beyond shelter inflation, we still continue to see strength. That's a labor market story. To the extent that the Fed can impact the inflation, it's through the labor markets. Labor markets remain strong. At next Friday's employment report, we expect another 250K job growth and the unemployment rate to stay at 3.8%. That's not a labor market that's slowing. The Fed still needs to do more work on that front to get structural inflation down.
I was just looking at the estimates. Sneak peek of next week, 250 is the median estimate in our survey, which is unbelievable. We're still pushing out some of these numbers. Michael, I promised you a conversation about the price of the story as well. Given everything you've just told us, it begs the question, why is there so much faith still about a return to 2%?
You know, it just seems like, okay, this print is high, but next month for sure. And we're just not getting that. So, you know, the market seems to be going back to that definition of insanity, where over and over again they expect something different, and it's just not happening. The Fed has credibility, and you know, it does seem like the market wants to buy into that Fed credibility. That as long as if inflation is high, well, the Fed's going to be hawkish, and therefore inflation will come down. We think that leaves break-evens quite cheap across the curve. But until the Fed shows that it might be more tolerant of inflation, longer-term break-evens are probably going to be stable in their current range. So it's really at the short end where we think there's potential for a big move up in break-evens. And at the front end, you have high real yields. Again, the market has taken out Fed cuts, or most Fed cuts, leaving real yields high at the same time that break-evens are low. So a hawkish Fed, but low inflation. Those aren't consistent in our view, and one of those should win out. We think that we need higher break-evens here to justify the high level of real yields and lack of Fed cuts.
Interesting. Michael, thank you, sir. You're one of the very best. We appreciate it. Michael Pond there of Barclays, setting up the conversation for about the next 5 minutes or so when we get that data. PCE just around the corner. Michael McKee joining us around the table to break some of this down. Mike, what are you looking for? And best guess yesterday, where did that surprise come from?
Well, the surprise probably came in upward revisions to January and February, as Michael was saying. But we'll look to that, and when you drill down into it, you got to go to 3 digits in these PCE monthly changes, and that's really nerdy economist stuff. But it will make a difference, because if that's the case, then we won't necessarily see March be pushed up as much.
How much of a surprise could some sort of beat in personal spending be, given yesterday's number?
It's very possible, because what we know about spending is that the retail sales have been, for goods, have been weak. In GDP yesterday, goods sales went down. So it's services, and if services come in strong, as they did in the GDP numbers, then we could see spending be a little bit higher.
The estimate for PCE is 0.3% month on month. The data drops next. Going into it, the scores look like this in the equity market on the S&P 500, positive all morning off the back of decent earnings from the likes of Alphabet and Microsoft. We're up here by 0.7%. Mike McKee's going to break down the number, and then we'll get the view from JP Morgan's Bruce Kasman. All of that and more up next.
This is Bloomberg. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is the last big inflation read going into the Federal Reserve decision next Wednesday. That data drops in 20 seconds' time. The scores going into it look like this, beginning with equities positive by 0.7% on the S&P 500. On the NASDAQ, bouncing by 0.9%, encouraged by blowout earnings from Alphabet, from Microsoft. If you switch up the board and get to the bond market, yields going into this one have been elevated over the last month or so. The 2-year, just south of 5%. The 10-year, just south of 470. We are lower on the session by 2 basis points at 467.12. With the economic data, here's Mike McKee. Morning, Mike.
Good morning. Well, it looks like sort of as predicted for the PCE inflation numbers. Both come in at 0.3%, the headline and the core on a month-over-month basis. We got to check that 3-digit number in just a second. On a year-over-year basis, the headline number is at 2.7. That's up from 2.5. The forecast was for 2.6, so a little bit more than expected. Same story for the deflator, the core deflator, 2.8% unchanged from the prior month. That is a little bit higher than anticipated, but not a huge move. It does show basically inflation is sticky and sticking around. Personal incomes up 0.5% as forecast. Personal spending, Lisa, you called this, 0.8%. The forecast was for 0.6. It was 0.8 the prior month. So Americans are still spending, gives more credence to the idea that the economy is strong, and with inflation where it is, this is certainly, I'm going to wager, this is certainly not going to change a lot of bond market thinking about when the Fed might cut rates.
Interested to see how the market responded to this. Straight away, spike in the equity market on the S&P 500. We're up by more than 1% now, up on the NASDAQ by 1.3. If you turn to the bond market, a rally started. Yields lower by 5 basis points on a 10-year, 465 on a US 10-year. Dollar yen still elevated for whatever that's worth, very close to 157 still at 156.85. Lisa, we've talked about this a few times, that sometimes with inflation, in line is like the new beat, or rather the downside surprise. When it comes to inflation, people are so spooked by the data yesterday that maybe the 0.3 is almost a relief.
Well said. I mean, I would just build on that by saying that if there had been an upside surprise, that was almost what this market was girding for. I wonder how long it's going to last, though. If this is a market that is fully internalized, what no rate hikes this year looks like. Because if what we are looking at right now, you know, I love what Michael Pond said. You could strip out everything that isn't inflationary and you get 2%. But right now, you have to wonder at what point you're looking at the new reality. And I think more people are going to have to grapple with that in the weeks to come.
PCE this morning coming in at 0.3%. The estimate in our survey, 0.3%. Month over month. If you are just joining us, equities are a lot higher in the equity market right now on the S&P 500, up by something like 1 full percentage point, encouraged by what we've heard elsewhere from Meta. Earlier this week, they were down, but the likes of Alphabet and Microsoft doing better than good in the pre-market this morning. If you turn to the bond market, yields are lower by 4 or 5 basis points at the moment on a 10-year, 466. On a 2-year at about 497. We're down 3 basis points at the front end of the curve. Mike, you've had some more time to go through this. What jumps out for you?
Well, I did look at the 3-digit moves, and it looks like at this point that January and February were revised higher. So you've got 3.8 for January and 3.4 for February. So that's where most of the change comes in. The March numbers come in at 3.00 or 0.300 exactly, so right on the number, and doesn't suggest that there was a big inflation build in March, which is good news. When we look at the personal income numbers, the important number is always wages. Compensation is up 0.6, wages up 0.7 for the second month in a row. So this tells you Americans still have money coming in and they can still spend. And we know from experience that basically people spend what they make. That's what drives them in this. So at this point, the numbers are pretty good. And as we said, the spending was higher than anticipated.
Well, I understand the stock market pop because of that. That basically this takes the stag out of the equation. This basically goes back to just the immaculate disinflation, except without the disinflation, just the immaculate, which raises this question about why this bond market is rallying on the heels of, on the margins, a hotter than expected print, but pretty much in line. Is there a sense that this is basically front-loaded this year and that you still could have that disinflationary impulse, or is this just basically the hope and the dream the Fed's going to find a reason to justify rate cuts regardless?
I don't know if they find a reason to justify rate cuts regardless, because their goal is to bring down inflation, and they've lashed themselves to that mast so tightly that it would be hard to see them just trying to push it through. But do we see inflation start to come down again? It's really hard to say, because a lot of what's been happening are one-off things you mentioned earlier that we don't know if they're going to continue. I haven't looked at the complete breakdown of the PCE numbers, but we know real estate's been an issue. Yeah. And we know there have been things like cars and airfares and things like that that have been issues. Do those continue to put upward pressure on? And what's the service industry pressure coming from? Are we seeing inflation because companies are raising pay because they're trying to attract workers? So those are the questions that the Fed has to answer, and we don't have good answers for all of them yet. As far as the stock market, not to tease ahead to Bruce Kasman, but I'm with him. We were talking off air. I don't know anything about why the stock market goes up and down in these.
Yeah, we're not going to ask Bruce about that. I can tell you this, Mike. I often say this whenever we get economic data at about 8:30 Eastern time. First move is not always the right move, and we will see if this sticks. But this is the move we have in front of us right now. There's a rally in bonds. Yields are pulling back. I think it's just a feeling, Lisa, and I think you'd probably go with this. This isn't about rate cuts. This is about whether this keeps rate hikes at bay. And data like that is going to keep that conversation at bay going into next week and beyond.
Fair. That's the whole thing about what you said earlier, this idea that anything in line is a beat, because essentially it doesn't necessarily reintroduce any risk. At what point, though, do all of these hotter than expected prints, one after another, it was supposed to be 3 that made a trend. Well, we've gotten that. At what point does that raise the question of, are we really understanding this paradigm correctly?
If you are just joining us, 0.3 was the estimate, 0.3 was the result on PCE. Equities off the back of it, positive. We've faded some of that move. If you look at an intraday chart of the S&P 500, spike higher, fall back, positive by about 0.9%. You got more detail, Mike?
Well, here's something that you may not have expected. If you're looking at overnight index swaps as a forecast for what the Fed might do, they've now priced November back in. Why? You got smarter people coming on. You can ask there. Fed funds futures still don't, but the swaps are pricing November. And that's very volatile, but it's interesting.
We were eating away at December yesterday after that data. We've been all over the place this week. Let's get to Bruce Kasman of JP Morgan. Bruce, Lisa's been quoting you all morning. That quote is the sound that you hear as a narrative cracking. How does this data inform that view?
Well, I think it's pretty supportive of that view on a number of fronts. Obviously, the one that people have been most focused on today is the inflation news, and certainly we got a more distributed, outcome of that surprise. It wasn't all in the March number, but the March number at 0.317 on an unrounded core is still pretty darn firm. I haven't seen all of the details as how that's distributed. I don't think the super core services were that high, at least what I see. But the basic point here is this is no longer something you can explain as just the beginning of the year pop. But I also emphasize 2 other things. One is, as you look at the data on income and spending here, we're getting very strong wage numbers. And I think there's probably some pressure here on wage inflation as well as there is the strong income numbers. We'll see the employment cost index report for the first quarter next week. And then the other thing here is we did have a squeeze on incomes to some degree, both for taxes and higher energy prices in Q1. And consumers held up pretty darn well. And one of the reasons is the savings rate went down. The savings rate is 3.2% in March. And I think that's a message that wealth effects are moving here. So there's both a story here about the economy holding up very well with high interest rates, as well as inflation pressures being persistent. And while I don't think it's right to talk about this from the point of view of Fed tightening, I think the case for Fed easing here is pretty small anytime soon. We'll see where we are 6 months from now, but certainly the Fed's going to have to change its tune about its its view that there's a fair amount of easing that's coming down the road.
I would just add that real personal spending actually increased to 0.5% from 0.4%, even though it was expected to fall. Bruce, given the fact that we're seeing or hearing that sound of the narrative cracking, what's the new narrative? Is it just no rate cuts in your case?
Well, I think the clear part of the new narrative is high for long on rates. The question is, where does that take us? And we've been actually struggling with that. We have kind of two scenarios we think are both reasonable. One we've been calling boil the frog, which is high interest rates do weigh on performance. They do start to create vulnerability on balance sheets, particularly the business sector side. And that causes problems for us, not now, but maybe 6 or 12 months from now. The second one is we find out that we actually can live with higher interest rates, that we've had better supply side performance. The economy is in an underlying resilient position, and that actually this is a new world, and we should understand that the economy has higher interest rates and is sustainable. Between those two right now, I think there's really support for both and some of the things we're seeing, and we're not trying to take a strong call on what the new narrative is going to be.
You do, though, think that there is going to be a new tone from the Federal Reserve next Wednesday when they give their press conference. What do you think is the right way to weigh the risks right now? How much should they shift away from what we saw in December?
Well, I think you have to remember that the May meeting is not a forecast round meeting. The May meeting is not one where we got a lot of new information since the last one. We really get a lot more with 2 payroll reports, 2 CPI reports up to the June meeting. So I think this is a bit of a way station. I think what Powell is going to do is he's going to basically say he's lost a lot of confidence in the views in terms of where inflation is going, but they haven't really shifted those views in a material way. He's going to downplay what the SEP in March was telling us, which still had 3 cuts for the year. And he's going to look to June for the bigger shift in the Fed. And obviously, we'll see that in the light of what we get in the next 2 sets of readings on both CPI and payrolls.
Just got a note, some reaction. This from Inflation Insight. The title of the note is just Core PCE, Few. I think a lot of people feel that way. Based on the information we got yesterday, there was a risk of a big upside surprise this morning, which is why we're basically saying that inline feels like a downside surprise relative to where expectations went to. That shift higher in yields. Yesterday, new highs for 2024. This morning, pulling back, particularly on a 10-year by 4 basis points, about 466 this morning. Bruce, I'm thinking who else is saying few this morning? It's officials in the Ministry of Finance over in Japan. If they're looking at dollar yen, staying up at 156.87 and approaching 157, the last thing they needed was an upside surprise. Bruce, can we take this global? What are global central banks, finance ministries around the world staring down the barrel of this resilient, strong dollar? What are they going to do?
Well, the first point to make here, which I think is really important, is we're seeing a world in which growth is broadening its base. And I think it is starting to take some of the weak links, including Japan and Western Europe, into a better position. I think in terms of what central banks are doing, there is more differentiation. We think the European inflation picture is looking a lot better than the U.S. So I think there is some room for easing. As you noted, Minister of Finance is probably breathing a sigh of release. I'm not sure they're that happy with the way the BOJ talked to us overnight. They were considerably more dovish than we expected in terms of their guidance. But I think the basic message here is you're going to get some easing in Western Europe. I think the BOJ is going to be patient here, but as you say, the yen is going to continue to be under downward pressure relative to the dollar. I think the pressure will build. I think ultimately Japan is going to do more, and the economy is going to do better than people expect. And I'd say that more broadly about the global economy, that they'll do less on easing, the BOJ is tightening, and we'll get better global growth than people anticipate at this point.
I know this is a difficult question, and everyone has a slightly different answer, and some people say it's not relevant at all. But where are we in the cycle, in the economic cycle, if you're talking about a broadening out and affirming of Europe, of Japan, at a time when a lot of other people are talking about U.S. exceptionalism and the potential for late cycle types of behavior?
So I think we come back to this tension on high for long. And I think what's embedded in the high for long is an inflation dynamic, even once we've taken out the highs that we had in 21 and 22, and a position in terms of monetary policy, labor markets that screams late cycle. But I think what the pandemic has done is it's both created that dynamic as well as a far more positive dynamic in terms of where the positioning, in terms of leverage, durable spending, profit margins, things like that, that are normally late cycle signals that tight monetary policy is going to do damage. So I think we're in a kind of a weird new world of late cycle inflation in central banks and early mid-cycle private sector behavior. How that plays out, I'm not feeling very confident right now. As I said, I think there's this possibility of the boil the frog and we gradually grind to a problem. But there is a possibility we can sustain this for a while longer, a while being a few years.
Interesting. Bruce, thank you, sir. Bruce Kassman there of JP Morgan. A while being a few years just makes you think of a theme that, Lisa, we've been talking about in this program, the prospect of it being post-GFC in reverse, where you're sort of sitting there waiting for liftoff, and liftoff never comes. You have to wait like 5 years for it. I wonder how long we've got to wait for that first cut.
It's already been that way for a number of months where we just keep talking about, well, next month. Was that also Michael Pond saying next month it'll be softer? And every month it seems to be the same story. The idea of a weird news cycle, how we invest around that, is definitely causing a lack of conviction, which is a reason why you see such significant moves, even on no real new information.
Well, I can tell you, stocks are back to where they were going into the print, basically, on the S&P 500, positive by 0.8%. Mike drops by because he's amused by price action sometimes, following data points. Mike, you've got a final word on this.
Well, I think Omar Sharif had the best word, phew. That seems to be what the market's reaction is, that we avoided a real problem, but it doesn't change the narrative at all. We're going to be still waiting for the Fed to cut. My two thoughts on that were, one, that Godot never showed up, and two, that the economy lived with rates like this for decades, and now we may be back to, we got to get Muhammad out, back to the old normal.
The old normal, not the new normal.
And people will adapt.
Mike, love it. Thank you, sir. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Blackstone is getting ready for a less risky, even more boring era for their private credit division. The head of the unit told me that to grow to $1 trillion, they're hunting for more deals in investment grade and asset-backed finance.
The asset-based finance market, which is a much larger addressable market, $25 trillion or higher, is a very large opportunity for us. And given our scale and our size, with about $420 billion on our platform in credit and lending at Blackstone today, it gives us this really unique position to take advantage of what's happening.
Gilles Dillard spoke with me exclusively in his first interview since taking the role. The University of Southern California has canceled its main commencement ceremony as pro-Palestinian demonstrations continue. The school cited safety concerns. Administrators had barred the valedictorian speech over her social media posts about the Israel-Hamas war. Dozens of smaller ceremonies will be held between May 8th and 11th for the university's individual schools. So far, 90 protesters have been arrested on campus. USC says that many of them were not affiliated with the school. Let's get you a quick check on Intel shares. They are lower by 8.5% in the pre-market trade. They're already down 30% this year. Intel gave a lackluster forecast in their earnings as it's still struggling to get back to the top tier of the industry. Stifel's Ruben Roy wrote that while 2024 should mark a bottom for Intel, the pace of the climb back up is still unclear. That's your Bloomberg Brief, John.
Danny, thank you. Appreciate it. Have a wonderful weekend. Equity futures right now on the S&P positive by 0.8%. Up next on the program, breaking down the inflation data coming in at 0.3% just moments ago. We'll catch up with Morgan Stanley's Andrew Sheets next.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
S&P 500 futures basically back to where they were at 829, which was a minute before the inflation data came out. We're up by 0.7% here on the S&P 500. Yields are a little bit lower. We've faded some of that initial move. We're down about 3 basis points, 467.75 on a 10-year. Under surveillance this morning, no bad surprises.
One that people have been most focused on today is the inflation news, and certainly we got a more distributed, outcome of that surprise. It wasn't all in the March number, but the March number at 0.317 on an unrounded core is still pretty darn firm. The basic point here is this is no longer something you can explain as just the beginning of the year pop.
It's the latest this morning. Stocks rising, yields falling after the core PCE deflator came in at 0.3% in March, in line with expectations and reinforcing the view that sticky inflation will leave the Fed in no rush to cut interest rates. Morgan Stanley's Andrew Sheets joins us now for more. Andrew, can we just get your initial reaction to that data from 20 minutes ago?
Yeah, thanks. I would echo kind of earlier comments. It wasn't as bad as expected. It could have been worse. I think after yesterday's numbers, there was a risk that you would have gotten a much higher number today on core PCE. I think that would have been much more damaging to the market narrative, narratives like our own, where we're expecting the Fed to be cutting several times in the back half of the year. But I think at the moment, it wasn't as bad as expected. The jury is still out on that, and the market will continue to be very kind of reactive and wait for incoming data.
Soft landings, as you've said repeatedly, they're super rare. Do you think the data's still tracking one?
We still think it is. I do think the growth data from yesterday was a little bit better than the headline number might suggest, given, once you adjust for inventories and exports. The inflation is not coming down as fast as we expected, but I think it's important to note that the Fed, still thinks that core PCE will be at 2.6 by the end of the year, and in that scenario, it's still cutting 3 times. So, I think that the moderation in rates, in our view, and we think in the Fed's view, doesn't require inflation being at target by the end of the year by any means, as long as we can see some progress. And I don't think we've seen that progress yet, but there's still some time. We still think we could be cutting rates modestly this year, and I think that's still very consistent with a soft landing type of scenario.
Andrew, we were just speaking with Bruce Kasman, I'm sure you heard it, and he was talking about him toggling between these two potential narratives. The idea of boiling the frog, where high rates eventually bite and create something that's more pernicious than a soft landing, or the idea of the new normal, which is basically we can live with rates here. Why do you think that we actually are going to be in the new sort of different kind of paradigm, where we're going back to the old, which is neither of those two?
Yeah, so I do think it's interesting that when we think about, going back to the old, and you mentioned before the break, kind of this idea of the old normal, and is that a problem for assets? Is that a problem for credit? And I think it's important to remember that the modern era tights for credit spreads, weren't during QE. They weren't during the structured credit boom of 2004 to 2007. They were in the mid-90s. They were in an environment where rates were high, where rates were higher for longer, where growth was okay, where the Fed cut a little but didn't cut a lot, and where corporates were slow or took time to really ramp up their aggression. So I think we can look at environments where higher rates in and of themselves are not necessarily a bad thing for credit. I think that obviously means you need to change your strategy somewhat. You need to think about kind of what could be larger and weaker beneficiaries of that. But, you know, I do think the mid-90s continue to be a very interesting template for what's going on and a quite actually optimistic scenario of how the market can deal with a somewhat higher interest rate environment.
We were speaking with Gershon Distenfeld earlier this morning, and he was saying, if you missed the opportunity to buy earlier, this is a good time to get back in. Would you agree with that, with the idea that higher yields, particularly on higher quality bonds, but also lower quality ones, look pretty attractive?
So I think our advice here it differs a little bit by what part of the fixed income spectrum we're talking about. So our rate strategists are neutral, and I think that's a function of, you know, over a 12-month period, we're expecting yields to decline. We're forecasting pretty good returns for government bonds, but the carry on government bonds is negative. The seasonality in April is historically pretty poor. The data's been good, and supply is heavy. So those are some, you know, notable tactical factors that are still kind of working against you and kind of keep us on the sidelines. Similarly with mortgages, you've had a lot of rate volatility, which is, you know, just very unhelpful for mortgage type of risk taking. But on the credit side, we're a little bit more optimistic. I do think this is a somewhat more friendly credit environment. Credit is an asset class where net issuance is lower than government bonds. The carry is much better. You know, the improving PMIs that we're seeing is more helpful historically. So, you know, I do think credit's a place that we think can outperform a little bit on a relative basis. And then within credit, we really like loans. It's a floating rate asset. Spreads there are average, not expensive, and the all-in yields are high. We think it's pretty well suited if we're in a somewhat hotter, somewhat higher for longer environment.
You alluded to supply. Can we finish on that? There's been a huge amount of supply to kick off 2024. I think we'd all like to know a couple of things. Has the window been open for lower rated credits? And a question we've asked on this program quite a few times now is how many bricks have we taken out of the so-called maturity wall that goes into sort of late 24 into 25?
Yeah, so we think that maturity wall is looking pretty good. A lot of bricks are coming out, so to speak. And you know, look, there's still wood to chop there. But you know, when our analysts in the U.S. and Europe look at that data and we break it down in quite some detail, we're making our way through that maturity wall at about the average pace that you usually do. And so I think you continue to see a market in credit that has a lot of differentiation. We're seeing a lot of idiosyncratic risk. We're seeing a lot of dispersion. You know, and everything. But I think on the whole, we're seeing that maturity wall be worked through pretty well, and that's a reason why we think the peak of the default rate for high yield or loans is going to happen in the first half of this year. It's going to be somewhat lower in the second as that gets a little bit better.
Andrew, this was great. Fantastic to get your reaction to the data. Andrew Sheets there of Morgan Stanley, responding to inflation coming in at 0.3%, in line with the official estimate in our survey, but maybe a little bit below where people were based on the information we got yesterday. Next week on Monday, have a wonderful weekend. On Monday, we'll catch up with RBC's Laurie Calvasina, Jay Bryson of Wells Fargo, Sarah Hunt of Alpine Saxon Woods, Stephanie Roth of Wolfe Research, looking ahead to payrolls Friday and a Fed decision on Wednesday. From New York, this was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, from our viewers worldwide, very good morning. I'm Manus Cranny. These markets, whew, it's a relief. The PC could have been a lot worse, and our faith is restored in big tech and the equity story. Go on, Alphabet. $230 billion of equity value restored. We count you down to the open right now. Coming up in the show, those stocks looking to close out their best week of 2024. Alphabet and Microsoft deliver the blowout results. Redemption. And more inflation data ahead next week's Fed decision. We take a look at the big issue. We're looking ahead to Chairman Powell.
There's both a story here about the economy holding up very well with high interest rates, as well as inflation pressures being persistent. And while I don't think it's right to talk about this from the point of view of Fed tightening, I think the case for Fed easing here is pretty small anytime soon. We'll see where we are 6 months from now, but certainly the Fed's going to have to change its tune about its view that there's a fair amount of easing that's coming down the road.
Will Powell change the tune? Mike McKee is with me. We just had the latest inflation data. What will that do to the singing from Jay Powell?
I think Jay Powell's going to be singing something like Friday, I'm in Love, The Cure, but it's Friday and the news is good, and it doesn't change the narrative for the Fed at all. Look at all the threes on the board here. 0.3% for the headline and core PCE on a month-over-month basis, same as February, although you go out to 3 digits, and January and February were revised higher, and that's what absorbed most of the rise in the year-over-year here. And what happened yesterday when we saw the quarterly numbers, the March numbers come in as expected, so no additional inflation pressure during the month from what we have, which is good news. Then you take a look at incomes up 0.5%. Wages and salaries up 0.7%. More on that in just a moment. And spending stronger, 0.8%. The forecast was for 0.6. So that gets rid of that stag idea in the stagflation narrative some people were pushing yesterday. Take a look at the annual rates. They did go up a little bit. That is partly base effects and partly the fact that we saw these 3 months get revised higher, but they're still at least in the 2s area, which is better than the CPI numbers. You take a look at the market reaction, and the interesting thing here is we still have inflation. It's still sticky. It's not going anywhere. But the market's priced November back into the first rate cut. Swaps markets are showing a chance of the first chance of a rate cut coming in November and then December. But right now, we're back to where we were before yesterday's GDP report came out. And finally, I want to talk about wages a little bit more because this is a political year and this is going to come up. What we're seeing with wages is that they are rising faster than inflation, and that's important. People haven't sort of sensed that yet, but wages up 0.7% and the month, and the core inflation number and headline inflation number up 0.3. the white line there, you're doing better. So do people notice that? Does it have an effect on the body politic? Interestingly enough, we get University of Michigan numbers later this morning, which give us something of an idea about where we are with consumer sentiment.
Okay, Mike, thank you very much. Putting context around the consumer, the wages, and the PCE. Joining me this morning to put context around this is Mark Haefele, UBS Global Wealth Management CIO, and Winnie Caesar, Credit Insights Global Head of Strategy. Now, you're both of a consensus the rates will come. You're both of the view that inflation will loosen its grip. I think everybody's breathing a little bit of a sigh of relief this morning that this could have been spikier and hotter. Mark Haefele, good morning to you. What does this data do to the narrative that inflation may loosen its grip? I don't think it emboldens it, does it?
Right, but it's not like this data point suggests the next move by the Fed is tightening, which is enough on a Friday for people to take their eyes off the inflation narrative, realize that spending, consumer spending remains strong, and focus back on earnings.
So is that good enough for you, Winnie, on a Friday? Woof, mop my brow. At least we're not going to have a hike.
I think it is a helpful data point on a Friday, especially after we've had kind of a chorus of hawkish Fed speak and some data that has not looked particularly encouraging on a disinflation perspective. So the lack of a true upside surprise in this PCE read, I think, will be helpful for markets to get a little bit of stability, especially in the rates market, which is important.
Well, let's just talk about that. I mean, we had twos over 5%. We had quite a significant amount of supply that came to the market. So I'm curious to get both your views. Mark, you first of all, in terms of duration. I know that ultimately your base case is we travel lower, we hit 3.75%. So my natural question is, on the dips in price and the spike in yield, are you an incremental adder of yield on sovereigns, and does it leave you with a robust credit outlook?
Yeah, well, our preferred move in the space would probably be investment grade and, 5-10-year duration more on the 5 side, because it's really hard to lose money when yields are this high, and from an investor's perspective. So when we had these debates about spiking rates in the past, rates were much lower. So I think now you have to take a little bit of perspective, because you can get these yields, you can lock them in, and they provide a lot of stability in portfolios at a time when there's a lot going on in the world.
Okay, I'll take you at your word. Hard to lose money at these levels. Winnie, with that in mind, I'm with Bob Michael here this week telling us to clip coupons, don't worry about the spread. And you're very much of the same view, which is keep on trucking, keep on clipping, keep on taking your yields in credit and sovereign.
Yeah, absolutely. We have moved back to a market weight or more neutral position across U.S. corporate credit, both in investment grade and high yield, because we like the yield environment. We think anytime Treasury yields in the long end are north of 4.5%, then you should be starting to add some duration to portfolios. But that barbell strategy, which has been very effective really for the past few years, I think will continue to serve investors quite well. And the carry that you get in U.S. investment grade and higher quality parts of high yield is very attractive from a long-term historic perspective. So I'm always a little bit reticent to say that it's hard to lose money, but we do think that the yield environment is very helpful for total return focused portfolio managers.
Haefele's survived a couple of drive-by cycles in his time. So with this in mind then, let's cast forward to Chairman Powell next week. I mean, here at the House of Bloomberg, we would say in many ways his pivot before Christmas was responsible for this Lausch FCON, this rise in inflation. Mark, to you, do we need some kind of a hard pivot from Powell that the timing of cuts is going to be much more delayed than we are still hoping for? I think November's back on the slate at the moment by the swaps market. Do we need a hard pivot from Powell next week?
Well, you used a couple of foreign words in there that I didn't understand, but I think he's going to have to walk back. The market's already walked away from cuts in the near term, and it's going to be more about data dependent. And we think a cut is more likely in September, because we do see that the hikes that have taken place are starting to have a little bit of an effect. We note that consumers have spent a lot of their excess savings. And I think most importantly for us, you know, the U.S. is an outlier compared to, say, Europe, where inflation continues to come down. So these things tend to move sort of in global cycles. So we just wonder how long the U.S. can really be an outlier with inflation continuing to go up.
Yeah, and that lies the point, Winnie, is that probably the view is that we had this pivot, this dovish pivot before Christmas. Here we are. We've got to hear what he's going to say next week. Does he need to reaffirm or at least convince the market that insurance cuts are on the way, even if they are back-ended?
Well, that's a great question. You know, I don't know that the market is necessarily going to take Powell at his word. They certainly did in December when we had that very dovish pivot, which in our opinion was a little bit of a mistake. We had expected Powell and the Fed officials to remain very hawkish up until that date of the very first rate cuts. January was a more balanced, if not slightly more hawkish message from Powell, which was something that we anticipated. And the market really didn't seem to respond much to that until more recently. Now we have some inflation data that's supporting that type of narrative. And so now the market, I think, has swung too far in the other direction, pricing out rate cuts for this year. And that's just what the market's done for the past few years.
Okay. Winnie, thank you so much. Winnie Caesar, Credit Insights Global Head of Strategy. Mark Haefele stays with us. A little bit more work to do on the equity side of the narrative in just a moment. Let's look under the hood. Ahead of the opening bell, Abigail Doolittle is with me. What have we got? Bit of tech?
Yeah, quite a bit of tech here. We have the shares of Alphabet absolutely rallying. The stock is set to add $230 billion in market cap on blowout results. This as AI has fueled 28% cloud growth. They also announced, of course, a 20-cent dividend and a $70 billion buyback. Microsoft also higher, not quite as much as Alphabet, but they beat on top and bottom line. Cloud grew by 31% for them, better than the 28% estimated. All helped out by AI demand as well. Snap up 25%. We've got lots of tech winners here, except for the last one, but daily app users rose 10% to 422 million. Current quarter sales could gain as much as 18%. There is an 8% short interest on this stock, so some of today could be a squeeze. And the odd stock out, Intel down 8.3%. A weak guide madness there is weighing on those shares.
Okay, yeah, certainly brutal for Intel. Abby, thank you very much. Coming up, big tech strikes back.
Speaks to where all this money is going. The monetization's here. And that's why as a tech bull, you were sleeping very well going into this weekend.
Microsoft and Alphabet deliver blowout results. The conversation next on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
It just speaks to where all this money is going. It is going to a fourth industrial revolution, and you could debate economics and everything that's happening on macro, but the monetization's here. And that's why as a tech bull, you were sleeping very well going into this weekend.
Big tech rallies going into the weekend. The stocks of Microsoft and Google boosted this after their companies showed confidence in their AI spending and cloud computing. Mandeep Singh is with me now from Bloomberg Intelligence. Added into that, Mandeep, good to see you. Google, first dividend ever, and a pretty good buyback. The search engine is doing well, but it is about AI, and it's about the growing up of AI in these narratives, isn't it?
It is, and look, they are integrating AI with pretty much everything they have on the consumer side, and then on the cloud side, clearly they have the infrastructure to deploy AI for their customers, and that's what's driving the cloud growth. So really, what caught my attention was the fact that YouTube plus cloud is now 100 billion ARR, and when you parse through the numbers, I mean, YouTube is almost 60 billion in revenue. Think about it, growing at a mid 20% clip. That's quite impressive, you know, and cloud is separate, close to 40 billion. Again, it's right up there with Amazon and Microsoft. I would argue it's growing faster than Amazon at this point of time, and Microsoft clearly is the leader when it comes to cloud AI, but really the numbers are getting better for Alphabet.
Have we consistently underassumed the underlying strength in Alphabet? I mean, YouTube, $8 billion in revenue, the strongest in 2 years, live sports. I mean, it's stream after stream. Is it the silent sort of comeback kid here?
And I think what's most impressive is it's got both ads and subscriptions. So think of it as, you know, a Netflix embedded in it with almost, you know, 20 billion in recurring subscriptions, plus an ad business. And their engagement numbers keep getting better and better. And if there is a TikTok ban, I would argue YouTube is one of the main beneficiaries of that ban. So clearly they're a juggernaut when it comes to the video consumption side of it, and it's showing up in the numbers now.
And just to square it away on Microsoft, obviously they have been seen as the leader in AI with OpenAI, et cetera. What nuance came through from them last night?
Yeah, so their AI workload revenue was about 7 percentage points of growth, a $4 billion run rate. And when you think about it, that business wasn't there 1 year back. So it's $4 billion in incremental revenue that has added to cloud growth, which was 31%, very impressive. And I'm looking forward to what Amazon prints when it comes to AWS, because they are the largest player when it comes to cloud, $97 billion run rate. Azure is $76 billion run rate. So clearly Microsoft is growing faster and it's closing in on that gap, but they are executing very well when it comes to AI workloads.
Snapping at the heels on the cloud, closing the gap. Mandeep, thank you very much. Mandeep Singh of Bloomberg Intelligence. Stay tuned to Bloomberg. We've got Pat Gelsinger of Intel, the CEO, joining the team at 11 a.m. Eastern. Still with me, it is Mark Haefele, UBS Global Wealth Management CIO. It's been a stomach-churning week for tech, Mark, hasn't it? Down $400 billion yesterday, saved by Microsoft and by Alphabet. When you talk to the clients, how much of Mag 7, how much more risk do they want to take outside Mag 7? How do you look about exposure to tech on the equity side?
Yeah, so, you know, I'm pleased with this week because I think it confirms some of our big messages, which are focus on quality in tech. There is a lot of focus on quality in stocks. There's a lot of tech in quality, and that AI is real. And I think, you know, when you see tech companies beating expectations, adding dividends, that is they have very strong balance sheets. That's a sign of what we mean by quality stocks that can weather, if interest rates are a little higher and the economy is a little bumpy. So that's number one. But when you look into what we're seeing here in this focus on AI, these results were delivered with massive CapEx into the AI space. And so I think if you drill down further on the AI names and their ability to continue to post very high revenue numbers and profits, I think that's exciting as well.
It's interesting how the genius of Musk was rewarded with many promises, perhaps less detail. The genius of Zuckerberg was not rewarded, and sort of his future investments or his moonshots were indeed the reason why it dragged back on the stock. When you look at tech, Mark, do you look at very, very unique moats? Many people have spoken to me about the moat that is around Elon Musk, the believer in the dream that is Musk and that is Tesla. When you look at huge tech names, what is the most important facet for you when you decide, okay, this is where we want to be scaling up our allocation?
Well, there's certainly, call it a moat, I think, or recurring revenues. And, where are the choke points? All of this, for example, AI growth that, many companies, even outside of tech are just waking up to, at some level still comes down to chips and chip supply. That's something of a choke point still. So I think that remains exciting. So, you can never look at just one thing. It's a mosaic theory. But again, those companies that are showing the growth, have the strong balance sheets, getting the recurring revenues increasingly, I think that's very exciting to us.
I was quite captivated by what Dan Ives had to say earlier. He talked specifically about Microsoft. I know you might not want to get drawn on an individual name. Masterpiece after masterpiece for Microsoft. But he talked about the general moment in time of where we are in the cycle, and I'd like to get your perspective. He talked about it being 1995 and not 1999. And $1 trillion worth of overall CapEx, additional CapEx to be spent by companies over the next decade. And I think that speaks very much to where we are in this cycle. What's your perspective of where we are? He says it's 1995 and not 1999.
Well, I certainly hope it's not 1999, but we have to watch out for that. I don't think it is for several reasons. First of all, I was just looking at my .com edition of Monopoly over the weekend, which I bought in '99, never opened, and all the companies that are gone to try and keep it real. But when you look through that, many of these companies did not have strong free cash flow, did not have strong balance sheet. It was about trading on clicks and eyeballs. That's one of the things that separates tech. Secondly, is this point about the CapEx that we see companies, across industries are deploying into tech, which I think is important. And then, what we hear from clients and consumers and we see in businesses, and I think increasingly we're seeing board of directors across businesses starting to ask CEOs, what is your tech strategy and what are you doing? And we see it in our own work, how we're using AI to speed up processes and save money. So, I still think that it is much closer to the beginning of this than the ending of this. And so, I haven't broken out the 1995 wardrobe like Dan did, but I think we're closer there.
I think Dan Ives has a couple of pink jackets he can lend both of us in various sizes and various shades. Mark, always great to get your perspective, you and the team. Mark Hafley, UBS Global Wealth Management Chief CIO. Coming up, morning calls a little bit later. Redemption for tech, well, redemption for the bulls for now. BMO's Carol Shalif joins me. After the break, we're going to talk about those blowout results. That conversation still ahead.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Ringing is telling you two things. One, a relief in tech, 2.3% up on these equities. You're looking at the best week so far. You didn't think that yesterday when it was $400 billion wiped off the equity market value. But there is a palpable sense of relief as Microsoft and Alphabet and Snap really charge these markets higher again this morning, up 0.8%. Alphabet is the leader of the pack this morning. Roll it over, have a look at the bond market. There's a palpable sigh of relief that the PCE was not a higher scorcher. Plus 0.3% doesn't say that you've got this big wave down on inflation. It doesn't reaffirm some huge disinflation narrative, but what it does say, it could have been an awful lot worse. And we had quite a bit of supply to get through this week. So yields just dropping a couple of basis points across the curve. Let me take you through your morning calls. This is what we got from the analysts on Wall Street. First up, Stifel downgrades Caterpillar to a hold after earnings, expecting limited upside due to weakening sales growth. Next up, Bank of America downgrades Hertz to underperform, saying the first quarter results failed to alleviate liquidity and cost concerns. That stock took a battering yesterday. Finally, HSBC double upgrade for Snap to buy from reducing signs of broad-based recovery in advertising demand. There's no doubt about it. Big tech earnings have given us that relief that we needed in these markets. So futures are rebounding on that. We'll take you through the opening markets in just a moment, right here on Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is
is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
See whether the bid endures. Certainly Bank of America's big note from the Flow Show says the monopolistic hold that big tech has on these markets can endure until the real yield hits 2.5%. And we still got a little bit of mileage to go on that, but you are seeing a furious rally on some of the Magnificent Seven, not least Alphabet, and of course Microsoft and Snap. We'll talk more about that in a moment. The breadth coming in there slightly as a laggard on the Russell, up 0.2%. The rest of the assets you've got, again, the dollar is slightly better bid this morning. You're looking at the euro down by 0.2%. Yields tick lower. The PC was not a lot hotter than the market had estimated at plus 0.3% on the core. So there was a sense of relief, really, in the bond market. And crude is up by 0.7%. I can tell you, we've managed to put on just over 2.5% this week. So while some of the geopolitical tension has eased out of this market, there's still tension in that oil market. So just keep an eye on that. Key time spreads suggest that we have a robust market. Tech stock, it's the only thing that we've really talked about for the past 48 hours. And Microsoft posting their sales and their profit on strong demand was a nice beat for them in AI. And it was a similar story for Alphabet, as we've been saying. AI fueling the crowd growth. Ed Ludlow is with me on the tech track. Ed, I mean, these are pretty stunning performances by Alphabet, putting back on $230 billion worth of market cap. So that's a nice relief to Meta.
It's a nice relief, and there's clearly a clear story across Alphabet, the parent of Google and Microsoft, which is all of the investment in AI infrastructure and R&D is manifesting itself now specifically in top-line growth for their cloud businesses. Alphabet, when I spoke to the president, CFO, and CIO, Ruth Porat, on the phone, she was very clear. They are seeing AI solutions make a meaningful contribution to cloud growth. But Alphabet's an interesting one. There is actually some frustration on the street about how little guidance they give and granularity. The stock's up 10.5%. Let's see where it closes. It will close at a fresh record high, very likely. But if you get above a gain of 12%, you're talking about the biggest jump since 2015. So it's a big response. I'd probably say, Manus, and I think you were discussing this with your guests earlier, the first ever dividend probably is a bit of a sweetener that's helping that stock move. Microsoft more muted, up 2.6%, and yet they gave us the granular detail. 31% top-line growth in Azure Cloud. 7% of that growth came specifically from AI products, up from 6% contribution in the prior quarter. So we have more size and scope with Microsoft. We know, basically, going back to basics, that when we're talking about generative AI, in other words, generating text, image, or video from a prompt, they're selling that as real product. And that is, in the enterprise use case, showing up really well in cloud for both of these companies. One other point on Alphabet to jump around between the two, I think there's a lot of confidence that the core search business is resilient, but YouTube is a real bright spot. And if you take YouTube in aggregate with clouds, the commentary was that the run rate on revenue is $100 billion. Executives on the call very much framing this, that if the search business matures, don't worry. We've got something called YouTube alongside our cloud business that's going to bring that future growth. Interesting moves on what's been a pretty crazy week for technology earnings.
And don't forget, Ed, if they ban TikTok, you've got your YouTube. Even more music to everybody's ears. Thank you very much, Ed Ludlow, on the tech track. Stay with that, because we've got Snapshare surging this morning as well, after the social media company posting a beat, as well as a positive outlook following their ad revamp. Abigail Doolittle has the detail. Wow, 25% up.
Pretty incredible, heading toward the best day since February of 2022. Now, it had been down significantly on the year into today, so making up some of that lost ground. The quarter that was okay. They did beat adjusted earnings and revenue adjusted earnings ever so slightly, basically flat, a profit as opposed to a loss. Revenue, though, was about 7% better. But what folks are really honing in on is the fact that their revenue projection for this quarter expected to grow by 18%. And they're really saying that this has to do with their revamp of their digital advertising business, gaining popularity with marketers. In addition, also positive is the fact that Snap daily active users rose 10% to $422 million. So this social media company getting a little bit of a break. One thing I would point out around this monster gain, right now up 28%, there is an 8% bearish short interest on this stock. So today's move could be a bit of a squeeze.
Okay, certainly a snap back there, excuse the pun. Abby, thank you very much, Abigail Doolittle. So Intel, they have had lackluster sales outlook for the second quarter, signaling that the boom in AI technology is diverting business away from Intel's traditional PC chips. This is a considerable headwind. Alex Semenova is with me to detail.
Good morning, Manis. Well, Intel is clearly the outlier today among the tech names that gave a disappointing forecast for the current period, highlighting its struggle to return to the top tier of the chip industry. Sales in the second quarter will be $13 billion, below the estimated $13.6 billion, and profit is on track to be just 10 cents a share versus a projection of 24 cents. The company's first quarter results were largely in line with expectations, but it's all about guidance this earnings season, and Intel did not deliver. It also failed to meet demand for processors used in its new AI-enabled PCs because its packaging facilities failed to produce enough components. CFO David Zinsner acknowledged that the business was slower this year, but he said that he expects an improvement later this year. Taking a look here at some of the analyst reactions, Cowen said that there is no getting around a tough set of results, and then Stifel said that this year should mark a bottom for the business, but it's unclear the pace of the climb back up. Shares are down here nearly 12%, the worst day since January 26th, and the stock was already down 30% year to date heading into this report, making it the second worst performer in the Philadelphia Stock Exchange Semiconductor Index. Manis.
Alex, thank you very much. Bloomberg's Alex Semenova there. So big oil, big disappointments. Exxon and Chevron reporting their first quarter results, and they both missed expectations. Now, the weak results are due in part to the fall in natural gas prices, lower refining margins in the first half of the year. Isabel Lee has the detail.
Hey, Manis, big disappointments indeed. We have Exxon and Chevron both reporting lackluster results. So Exxon posted an EPS that was 13 cents lower than Bloomberg's average estimate. And this is despite the surge in crude output from its development in Guyana. So shares are now edging lower. Chevron, meanwhile, this is where some confusion is happening because when it opened, shares popped, and now it's edging lower. And I think it's because revenue forecasts fell short, but EPS surpassed expectations as well as oil production. So both these results come amid a shift in investor expectation that favors oil production growth, and that, as we know, investors are taking advantage of concerns of global supplies, and this supports crude prices. One bright spot for Exxon, though, was the cash flow. It came in at $14.5 billion, so this is $1 billion higher than forecast, again boosted substantially by its Guyanese production. So for the past 2 years, both of these firms have really enjoyed unprecedented profitability in their histories as energy prices really surged to record profits. But since the onset of the war in Russia and Ukraine, oil and gas prices have largely stabilized, and now shares are edging lower still. You have Exxon down 3%, but year-to-date it's up 17%. Chevron year-to-date is up 11%, Manis.
Isabel, thank you very much. Isabel Lee there with the very latest on big oil. My next guest weighs in on the recent market volatility, saying this: a 5 to even 10% pullback in stocks is a normal course of events after the exuberant rise of October 2023 lows. And we are seeing a recalibration going on in stocks and bonds. It is Carol Schilif. She joins me now, CIO at BMO Family Office. Carol, thanks for being with us. I mean, we haven't had a 5% drawdown. We've had nowhere near a 10% drawdown, and yet we're dealing with 2-year rates above 5%. So is the equity market still set for some kind of a day of reckoning relative to the bond market?
You don't necessarily need to have another day of reckoning. We did see a 5% sort of pullback, and then you had interest come in, because I think markets really are trying to deal with that tug of war between looking at the short term and then understanding that we're in the midst of a major secular trend here. We're reinvesting in infrastructure. We're reinvesting in a lot of things to put productive capacity into the United States. And so investors want it to happen in the short run. They want to see it happen today. And yet there's a lot of themes that are supportive of that underlying growth rate.
And the whole premise here is that the rates, as you say, we don't need another dramatic day of reckoning, and that's not necessarily what I'm calling for. But I'm drawn to what Bank of America had to say this morning, which is this monopolistic field to the Magnificent Seven, to that top echelon of tech, can continue until real rates test 2.5% to 3%. And there's still a country mile to go until we get to that level of real rates.
Right. We do think that we've broken the back of the zero interest rate or the negative interest rate environment that we've been in for the last 10 or 15 years. And we would agree with that move towards real rates of 2 or 2.5%. You're going to see a lot of volatility in the markets as they adjust to, the interest rates not coming down as fast, the top line rates not coming down as fast as the Fed would like to see or anyone would like to see. But that's because there's so much underlying growth in the environment, and having a bit of inflation, once investors remind themselves or understand that having that bit of inflation in the system is actually pretty healthy from a long-term standpoint, because it allows for some modest wage increases, it allows for pricing power, it allows for a lot of things. But this adjustment we're in the middle of means it's kind of confusing anytime you go through regime change from 0% rates towards 2 or 2.5% rates.
Yeah, I mean, the theory is that we're nearer the end of the regime change and perhaps about to see some kind of reversal of that regime change. Were you heartened by the wages component of the data today? I mean, the PCE was almost like a relief in that it could have been an awful lot worse, but the wages component was strong, up 0.7%, far outstripping that of the inflation narrative. The takeaway and the consequence of that for you from an equity perspective?
We do expect that you'll see a somewhat of a softening in the wages component, especially by the end of the year. But overarchingly, there's a lot of health in this economy. The PCE was pretty indicative of that. We've got growth coming through. We're not seeing a big tail off in that. We've got healthy employment markets. You saw it in the unemployment claims earlier this week, still being at a very muted level for this far on in an expansion area. And I think those underlying trends of reshoring, friendshoring, having the data center, the data center draw on the grid, the need to improve the grid. There's tons of stuff going on in the country here that really make for it an important secular theme. And so investors really have to figure out an anchor to that new level. You've even seen it in the housing market. When we get the mortgage rates down below 7, now people are anchored to a higher rate than they were a couple of years ago, and you see activity pick up.
And you're seeing some value stocks do sort of mightily well, even in this higher rate regime in a relative sense. The likes of GE, et cetera, sort of seeing a couple of these ETFs with high value components in it. So that's about what, having gotten through or perhaps not facing the same kind of refinancing cliff as many people had perhaps worried originally.
Yeah, well, I think a lot of companies had some fixed rate debt involved. And the unique thing about this market is you're seeing it even sector by sector. It's tough to paint a whole sector with a broad brush. It's really an active managers kind of market where it's stock by stock, company by company. What does their balance sheet look like? What is the interest rate environment on their own unique balance sheet? What are their needs for capital expenditure? And so it really is an interesting market. And we would push back a little. It's not just the Magnificent Seven carrying the market or the Magnificent 10 or whatever. There's a lot more breadth in the market, and there's people looking for who are the second and third tier plays, not just the makers of AI chips, but who are building the data centers, who are facilitating the hooking up to the grid who are facilitating the water rights. You know, there's a lot to consider here.
Yeah, as you said, it's about trying to think a little bit more broadly in terms of what the entire chip story is. Carol, thank you so much. My guest this morning on All Things in the Market, Carol Schleif. Coming up on the show, we'll take a deeper dive into Exxon's disappointing showing in the first quarter. More on the big oil move, but I just want to show you there is Exxon down 2.5%. Intel extending its decline to 13%, the biggest drop since July 2020. This is how tech worlds and chip worlds divide.
Season 2 of The Circuit. We're walking with the titans of banking.
Hello! You guys love these meet and greet things.
We do! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a character.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
The share is down. The company missed on their earnings per share estimates. The oil giant said it expects $60 billion acquisition of Pioneer Natural Resources to be approved by the end of June. Joining us now is David Withey. He is the reporter tracking this story. So if I look at the results here, what was it that's proved the flesh wound, if I can call it that at all?
Yeah, probably if you really had to point to just one thing, it might be the refinery maintenance schedule that was a little bit more heavy, that sort of dragged down the results. And sometimes that can be hard for analysts to predict, but then there's also some non-cash charges that also were hard for the analysts to model. And so that drove a lot of the miss. And then just from the earnings call that we just got off of, there weren't a lot of really new excitement or fireworks to get investors excited about. And so that's kind of driving the overall drop in the shares right now.
CEO says cost cuts to hit $15 billion by 2027. Just tracking it on the T-Live for anybody that's tuning in. It is all there, the exact details that you need. Look, if the presumption is the Pioneer deal goes through, that gives them 15% of the overall oil production in the Permian. Is that transformational or is it incremental and all in the price?
Yeah, it really depends on what they do with the Pioneer production, because they've said that they want to actually grow the production from Pioneer. A lot of the historical trend has been, though, when big M&A deals happen, that the company will cut the production. So the question out there is really whether this will actually raise production or not. And Exxon says it will. And so investors are hoping that will be the case because they're more open to oil production growth happening in key places like the Permian and Guyana.
Do you think it's OPEC's work and a tighter market that has induced the Permian and U.S. production and exports to a manageable level? I mean, can we all coexist? You know, because we've gone through the Permian, racing to produce, irresponsible leverage, etc. We've learned our lessons of the past. Here we are at $90 oil. How healthy is that? How much is the Permian dependent upon the goodwill and the constraint of OPEC+?
It's definitely helped. There's no doubt about that. The market, the oil market in general, is healthy right now because no side is really going crazy with production growth, and so it seems that if all areas kind of go with this sort of moderate growth, then it sort of helps things. And it's a different mindset entirely for the Permian producers. Saying that, I will also note, though, that Chevron and Exxon are both stated that they plan to grow production by 10% this year, and that's about twice as much as what most independent E&Ps have said. They plan to grow about 0 to 5% in the Permian. So, you know, that's about the one outlier. But generally speaking, the Permian is going moderate in growth, and that's mainly to send profit back to shareholders. So as long as that continues, it seems like it stays a relatively healthy oil market globally.
David Wethy, thank you very much. Let's see what OPEC Plus do in June. Of course, when they meet in Vienna, they can always act before then. Unlikely, as it seems at the moment. Sector price action for you. Abigail Doolittle is with me with the details. Abby, what have we got?
Well, we are looking at the S&P 500 up about 0.8%. Not surprisingly, a lot of this has to do with Alphabet and Microsoft. The best sector on the day, communication services up 4.8%. Yesterday, it was down on Meta. Today, it's up on Alphabet. Tech being driven by Microsoft. To the downside, though, you're just talking about Exxon and Energy down 1.5% on the day, along with healthcare, utilities, and financials. On the week, though, we are looking at the best week, most likely, potentially, of the year. And this is being driven by all 11 sectors higher, the best sectors. Tech, discretionary, and then interestingly, utilities in there up 2.1%, even with yields high. And then there is communication services. So mainly those three mega cap tech sectors, Manus, they're a big part of this week's gains.
They are just plowing ahead. I'm just looking here. Google, the parent of Alphabet, over $2 trillion. So fourth company in U.S. company to hit that milestone. Hello, Apple. Hello, Microsoft. Hello, NVIDIA. Abby, thank you very much. Coming up, market moving events. Let's set your diary and give you your details on Bloomberg.
This is Bloomberg.
DOJ or other authorities
Could face bigger challenges.
Britain's next was going to keep winning World Cup. This is a 3 as the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Of tech yesterday and $400 billion wipeout to a veneration of Alphabet, to Microsoft, which is about the delivery within tech, within AI. And if you can give us the detail, then you are rewarded. Just look at the $230 billion being reapplied to Alphabet's valuation. What else is driving this market higher? It is the wages number within the PCE, plus 0.7%, way ahead of core PCE at plus 0.3%. Therefore, real wages are rising. Hence the reason why you see this perhaps resilience a little bit in the Russell. So overall, you've got equity markets giving you the best week of 2024. Have we already chowed down on the fact that we are facing over 5% on the very short end of the yield curve at over 5% at one juncture in the two-year paper this week? The auctions went fine. Your trading diary for you. We will get the University of Michigan sentiment at the top of the hour. More consumer data on Tuesday. We're going to get the conference board consumer confidence numbers. Have those real wages transferred through to spending and hope. Chairman Powell speaks on Wednesday. Is there a pivot to be had there? Then it's all about Apple. We know they've had a tough time in China. We had that detail this week, so we'll get a little bit more exacting detail on Tuesday. Friday, we will get the ISM services data. That is everything that you will need to know in terms of the services component and inflation. That was countdown to the open. The tech market very nearly broke yesterday. It reasserted its strength and conviction, let's say. That's it for me and from all the team on Countdown to the Open. The rest of the Bloomberg team will take you through the rest of your trading day. A very good morning from New York. Thanks for being with us.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. It is Friday. We've made it. You're listening to Bloomberg Intelligence. For the next couple hours, we're going to break it down on these markets. Look at these earnings. A lot of earnings coming out this week. We're going to break it down on the tech side with Mandeep Singh and Anurag Rana from Bloomberg Intelligence. On the energy side, Vince Piazza, he covers all the energy sectors for Bloomberg Intelligence. He's going to join us as well, so we'll break it all down. It is Emily Gaffeo sitting in for Alex Steele. Alex is on holiday. Reportedly will be coming back on Monday. We'll see if she can come back from the Caribbean. That is debatable. But I'm Paul Sweeney. We're here in the Bloomberg Interactive Broker Studio. We're going to break it all down for you for the next 2 hours on this Bloomberg Intelligence program. Right now, let's kick it all off. Lisa Mateo's got a Bloomberg Business Flash for you.
You got it. A Market Driver is brought to you by Interactive Brokers. Discover the future of trading with their next generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. All right, just a few days ahead of the Fed decision, traders kind of breathing the sigh of relief after today's economic data. Core PCE increased 0.3% from the prior month. That was in line with estimates from a year ago. It advanced 2.8%. Meanwhile, personal spending in March, that rose 0.8%, which was more than economists were looking for. More data coming in now. We get to the University of Michigan's April read on sentiment. The survey was for 77.9. It came in at 77.2, so a tick lower than expected. We'll go to the markets now. The Nasdaq up more than 1.5%. The S&P 500 up nearly 1% right now, and the Dow Jones up about 0.5%. Over to commodities, we have spot gold higher at $2,342 an ounce, and we have Brent crude $89 a barrel, NYMEX crude $83 a barrel. Ending off with the bond market, the yield on the 2-year at 4.97%, down 2 basis points. The 10-year yield at 4.65%, and that's down 5 basis points. That is your Bloomberg Business Flash. Paul and Emily.
Lisa Mateo, thank you so much. We appreciate it. Emily Gaffeo sitting in for Alex Steele today. Good morning, Emily.
Good morning. Happy Friday.
Happy Friday. Emily Gaffeo, she's over there at Bloomberg News, and she comes over here whenever we have a need to help us out for the next couple of hours. So earnings day, Emily, we got a lot of earnings. We got some economic data today with a PCE core deflator. I kind of looked at the core deflator month to month, 0.3%, kind of right in line with expectations. Mm-hmm. You combine that yesterday with a little bit slower GDP, but their inflation gauge yesterday was a little bit higher. So kind of a mixed bag that, talking to a lot of experts this morning, kind of suggests the Fed can maybe just, again, sit pat right
Yeah,
here.
and we're seeing that kind of reaction in the bond market with Treasury yields moving lower just a little bit, but you look at the 2-year down about 2.5 basis points to 4.9. We are in that quiet period for Fed speak.
Thank goodness. It seems like they talk all the time. I don't remember that back in the day. Looking at the markets again, as Lisa was just reporting, up about 1% on the S&P 500. Let's bring in Abigail Doolittle. She is our markets reporter for Bloomberg News. She is here in our Bloomberg Interactive Broker Studio. So a better day today, a better reaction today. What are you seeing, Abigail, today, maybe versus yesterday?
You know, the reaction to the big tech earnings for sure. The fact that Alphabet and Microsoft being very favorably received for solid growth. Alphabet for their cloud, Microsoft as well. Alphabet's cloud product grew 28%, Microsoft 32%, both being driven by AI. So there was some question as to whether or not AI would show up in revenue. We now know the answer to that, so that's certainly a positive. It's interesting, Alphabet not quite holding the really frothy gains of earlier. It's still up 9.8%, but earlier it had been up 13, 14%. So it's going to be interesting to see how that one trades as the day goes on. Microsoft up 2.2%. So similarly, Microsoft had been up more than 4%. I'm curious to see, actually, I'm going to type it in right now on the week to see how much it is or is not up, because it had it. So it's up about 2.3%. Actually, that's actually the daily bid. So it's up, let's see, it's up about exactly the same amount. So today, whatever Microsoft does today, it shall do on the week. That's about the way that it's stacked up. And then on the other hand, you have Intel, super ugly, the worst day last I looked since April of 2020. That guide just not great. They've been trying to do a turnaround there for a while. CEO Pat Gelsinger, and apparently it's not going so well, at least right now.
Yeah, and boy, I have to admit, that's really disappointing for an Intel. You think about the AI play that's lifted so many of the chip makers, most notably NVIDIA, and they can't get any of that lift, can they?
Yeah, that's got to be frustrating for those shareholders, for sure. And then, you know, you're just mentioning NVIDIA. Maybe that's one reason why that stock's up 3.5%, and another reason why we have these indexes at this point up about 1%.
And Abigail, you mentioned Intel at 11:05 a.m. today, Wall Street time. We're going to be covering a simulcast with Bloomberg Television. Intel CEO Pat Gelsinger is going to speak with Bloomberg Technology anchors Ed Ludlow and Caroline Hyde following their earnings. So we'll get to hear from the CEO today about what they're looking to do here. Again, stock down here today on back of those numbers.
What about Meta, Abigail? Because when you look at the week performance, that's down 8%.
Yes.
How do you square Meta with the other big tech earnings, you know, that were positive? Are we starting to see kind of a, I guess, bifurcation in that Mag 7 sector?
Meta's coming back down. Great question. Meta's, I think, is coming back down to earth. So into its quarter over the last year, Meta had been up 130%. Alphabet and Microsoft had been up maybe 5 to 10%. So too far, too fast, perhaps, on Meta. Now, they had been putting up really good results, so I think that was a piece of it. The year of the efficiency last year had really paid off. Now I think people are very scared by the year of the metaverse the year before, when expenses went way high. Now, you know, AI spend, I would argue, as a non-expert, to either the metaverse, which sounded ridiculous to me the first time I heard it. I couldn't even believe that they changed their name.
I
It's
know.
like, you have the best branding in the world.
Exactly.
Why would you give that up?
Looks like a
Especially
video
since
game.
How do you, like, I don't even know if you can depreciate it or amortize. I mean, but it was just like, what are you doing there? But in any case, yeah, exactly, like a video game. And I mean, I just, you know, but I think AI is probably not going to be the metaverse. Even so, I think that people are just fearful of an overspend that may not potentially pay off. But in terms of the stock performance, you know, Meta is still up, you know, more than double over the last year, whereas these other stocks up closer to 10%.
Yeah, it's what's, again, you're right. The Meta story in 2023 was a great story, and even the beginning year to date in 24 was a great story on cost cutting. Not necessarily, not necessarily the top line growth, which we usually associate with these social media companies, and then to hear that in the, you know, in the background of the conference call, like, oh, is that, so are we going to go back to spending here? So what do you make of just the market overall here today, Abigail? I mean, again, a lot of market observers have been saying, you know, this market can, in fact, and should maybe consider some type of pullback or drawdown of 5%, 7%, 10%, maybe even more, and that wouldn't be the worst thing in the world for the long-term health of the market. We were down, I guess, 5%-ish there. Was that it, do you think?
I think that there is more to come. As you know, I love charts. So if you were to look at the daily charts actually look like maybe they're trying to put in one of those quote-unquote V-bottoms from other years. And those are generally driven by the Fed. That's one reason from a fundamental standpoint to not trust this. They're also generally after much bigger pullbacks. They don't usually come successful ones after, a 5% drop. So that suggests that the reason congestion is actually probably a pause in the bears. The sellers need a little bit more ammo. But when I turn to the weekly charts, they look like death. So they look like we're going to see another big drop down, possibly toward the 200-day moving average. Of course, next week we have the Fed. We have a lot more earnings. So let's see how it plays out.
All right, just looking at the S&P sitting right at 5,100 here. Nice round number, up 1%. So Abigail Doolittle, thank you so much for joining us. Abigail, she is the markets reporter for Bloomberg News, joining us here in our studio in New York City. We're a little lonely today. Friday's not a big in-person day.
Not a lot of people in the office.
But we're here in our Bloomberg Interactive Broker studio, but we are kind of lonely here. But I'll tell you, we're joined now by Sarah Ponsek. She's a financial advisor at UBS Private Wealth Management. She's based down in Boca Raton, Florida. Nice trade from New York City. She joined the mass of moving down to Florida. She was actually a little bit on the early side. Sarah, thanks so much for joining us here. A lot of earnings, a lot of economic data this week. We've seen some volatility in the equity markets, pulling back maybe 4 or 5% here off the peak. What are you telling your clients at UBS?
It's great to be here with you both. And yes, I was part of the mass exodus down to Florida, but I tell everyone that I was raised here. I'm from Florida, so
that's right.
I have a little bit of a leg up. But no, look, this was a big week in terms of information. When you think about what's driving the market right now and what is most important when it comes to thinking about the market outlook, there's really two components of that. One, inflation and growth, which we had insight into this week, and two, tech and tech earnings, because so much of this rally that we have seen over the past 5 months, past year, has been predicated upon this assumption that we are going to see unbelievable growth in AI. Now, with that said, what did we learn this week? Honestly, nothing too new. The PCE numbers this morning, they came in pretty much bang in line with expectations. Inflation's sticky. We all know that. The Fed's dealing with it, and they're just waiting at this point in time. And we saw some unbelievable tech earnings overnight as well, proving that CapEx spending in AI is paying off. So, as for what we saw this week, how that reflects into the outlook for the market ahead, there really isn't too much of a change at this point in time.
Okay, so when you look at the macro data, not just this week, but what we've seen over the last several months, are we really going to get cuts this year from the Federal Reserve, Sarah?
It's a good question. I think it's the million-dollar questions on everyone's mind. And frankly, I don't even know if Fed Chair Powell and his colleagues at the Fed know the answer to that question right now. Look, our economists' base case is that we will still see 2 Fed rate cuts this year. Coming into the year, our expectation was for 3. We never bought into the market's expectations that we might see 6, 7 rate cuts throughout 2024. We were standing pat at 3. That has since been revised to 2, with that starting likely in September, sometime in the back half of the year. But again, the only way that we are actually going to see that come to fruition is if we see progress on the inflation front. And right now, there are concerns and question marks surrounding that. So I would say, if we think about what's the biggest risk to our base case right now, what's our biggest risk to the market outlook? It is that inflation stays sticky for longer and that those cuts just get pushed out into the future. And I know there has been some talk of even a rate hike at this point. That's not our forecast at this point in time. And we would, there would be a lot that would have to happen. We would need to see a reacceleration in inflation for us to believe that that might be on the table.
So, Sarah, when you speak to your clients, kind of what are you telling them here as it relates to any change in maybe asset allocation, stocks, bonds, alternatives? What's kind of the message you're trying to get across to your clients?
So the message within the last couple of weeks, because it seems as though, investors always have short-term amnesia. You see any blip in the market, any volatility, and there's concern. So even amongst clients of ours who, have had phenomenal performance over the last year after overall, if you look at the S&P 500 over a 5-month span, we saw the stock market almost just go straight up 30% over 5 months. And all of a sudden, over the last couple of weeks, we are faced with volatility and we see a pullback. What are we telling them in relation to that? Well, one, we all have to know as investors, pullbacks are normal. Corrections are a healthy element of the investment process. In fact, if you actually look at how often we see 5% pullbacks in the stock market, on average, they happen about 3 times a year. So making sure that you don't see this pullback as a reason to completely throw your plan and strategic asset allocation out of place. Now, as you're asking a question as to what we're talking about, if we're making any changes as it pertains to asset allocation, I would say the biggest message to get across right now for a long-term investor who's trying to build wealth long-term is if you're sitting on a lot of cash right now, which a lot of investors are, if you look at the amount of cash in money market funds, it's above $6 trillion. So there's a lot of cash out there. At this point in time, you should be looking to buy bonds, lock in yields, because yes, it's great that you can get a juicy 5.5% in a money market right now on your cash, but what are you going to be thinking? And I'm not even going to say a year from now, but 2-3 years from now, if we see interest rates come back down and all of a sudden you didn't invest your cash, you're not getting a return on your cash. And by the way, at that point in time, you can't go out and buy bonds yielding what they're yielding now either. So making sure that if you're someone who's sitting on a hefty cash position, working through a plan and making sure that you're putting that cash to work, at least in the bond market at this point in time. For stocks, look, we're seeing volatility. It might make sense to ease into the market over a period of time. You don't need to do it all at once, but it's time in the market, not timing the market, that matters. And over a long period of time, cash is not the best asset class to be sitting on.
I'm wondering what you make of the boom in some of these options-linked products. I write about ETFs, and earlier this week I wrote about a new ETF that offers 100% downside protection, but it caps the upside. We know that covered call ETFs have seen about $70 billion. Is that a product that people are interested in from your view, Sarah, or is it just an easier bet to just buy bonds? Don't worry about all this complicated stuff.
Well, it's a completely different, investment scenario. Investors who are looking to trade options, or, we do work with clients when it comes to structured products or structured notes as well occasionally. Investors like the idea of, being able to have their cake and eat it too. In essence, what you're describing is an investment product in which you can get upside but limit your downside as well. Well, investors, would take that any day of the week. Of course, there's always trade-offs, and I don't know the specifics of the ETF that you're speaking of, but I would imagine that there's got to be some trade-offs. You can't get 100% upside in the stock market and yet cap your downside 100% as well. But I would say from our perspective, more so I have had clients who might be sitting on, and I'm not going to name particular names, but maybe a large mega cap tech stock that has run up significantly over the last year, and we're talking about different option strategies with them on how to limit their downside or how to maybe take some profits while being really smart and tactical about the tax implications of realizing those gains as well. How do you deal with the actual ramifications of having a position in your portfolio that has performed phenomenally? That's great. But at that point in time, if it is a significant portion of your portfolio, how can you diversify out of that position? How can you limit your downside, but while being cognizant of the tax effects as well?
Hey, Sarah, thanks so much for joining us. Always appreciate checking in with you. Sarah Ponczek, she's a financial advisor at UBS, Private Wealth Management down there in lovely Boca Raton, Florida, going back to her home state there. Coming up, we're going to break down some earnings here for the technology companies. Again, Microsoft, Alphabet had some really good numbers. Stocks trading higher. Alphabet all-time high. We've got Apple next week. So some more tech earnings coming up here, but tech's definitely leading the way here. The S&P is up 1%, but the NASDAQ's up about 2%, so kind of reflecting what we saw out of some of those big tech companies. So we're going to check in with two of the leading thought leaders at Bloomberg Intelligence on technology. That would be Anurag Rana and Mandeep Singh. They're going to join us in the next segment, and we'll break down all things tech. And I want to get a preview from Anurag on Apple, because there's a tech stock that has not necessarily performed or alongside some of the other big tech names that have been up so much this year. There's definitely some concerns about Apple. So we'll break that down in coming up. Right now, the S&P's up 1%. Again, NASDAQ up 2%. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks are moving higher this morning with the NASDAQ up more than 1.5%, the S&P 500 up 1%, the Dow up nearly 0.5%. And this after some more economic data came in this morning. Also after blockbuster tech earnings from Microsoft, Alphabet that really topped estimates. We'll check in with them now. We have Microsoft up nearly 3%, up 3% right now. Google, Alphabet's Google up 9%. And then you have Snap shares leading the boost this morning. They're up 23%. And then on the flip side, Intel shares, those are falling. They're down about 10%. And that's after the company gave that lackluster forecast for the current period. Over to the bond market, we have the 2-year yield at 4.97%. That's down 2 basis points. The 10-year yield at 4.64%, and that's down 5 basis points. To commodities, we'll head over there. We have NYMEX crude higher at, where are we going? Spot gold, all these numbers flashing. We're heading 2,342 an ounce. Brent crude, $89 a barrel. There we go. To currencies, the dollar is higher. Japanese yen, euro, British pound weaker. Bitcoin, we have down about 0.2% at 64,596. That is your Bloomberg Business Flash. Paul and Emily.
All right, Lisa Mateo, thank you so much. We appreciate that. Of course, Emily Graffeo, she's sitting in for Alex Steele here this morning. It's Paul Sweeney also. We're live in the Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast, and that's where you can find us. Let's talk tech earnings. Lisa was just reporting on some of the tech names. Both Microsoft and Google reported numbers last night, beating expectations, putting up some pretty solid numbers. Both stocks trading quite well here this morning. Let's bring in Mandeep Singh and Anurag Rana. They are senior technology analysts for Bloomberg Intelligence. Mandeep is here in our Bloomberg Interactive Broker Studio, and Anurag is in Chicago. Anurag, let's start with you. Microsoft, what did you see from our good friends in Seattle last night?
Yeah, I was a bit surprised. I think the beat was much more than what I had anticipated. I was actually a little more pessimistic going in, but they really showed that they are the one software company that's really capitalizing on the AI demand. So I mean, all good on the Microsoft side. Margins are good. Outlook is good. So no bad news there.
All right, so Mandeep, let's likewise on Alphabet. I'm seeing the stock, 52-week high today, just ripping. You've liked this name. You've been on top of it all along. What were some of the takeaways from the quarter last night?
Yeah, this was one of our focus ideas because everyone thought their traditional search is getting disrupted. They're going to lose share in search. And what they showed us last night is not only, they have maintained their share, GenAI is actually helping engagement with their search. And not just search, on Maps, on YouTube. And on top of that, I think what really should excite investors is they have got the cloud business where you see accelerating growth along with YouTube. So now it's a $100 billion ARR business going at 25% without any impact to the cost. Remember, everyone thought, oh, the search queries are going to cost more because you have to use this GenAI infrastructure. No, there was a 500 basis point margin expansion in search. So clearly they have executed very well, and it's not a one-quarter thing. I think this is going to continue.
So Mandeep, the cloud operation for Google, first quarter profit of $900 million. That was ahead of estimate projections of $672 million. So can you talk a little bit more about what's fueling that beat in the cloud side for Google?
I mean, in the case of cloud, there is one traditional cloud revenue, and then there is the GenAI linked cloud revenue. Mm-hmm. And what Google has done well is, one, they are getting the NVIDIA GPUs, and that's where, the 60% increase in CapEx is coming in, and the market didn't mind that CapEx increase in contrast to Meta, where the stock fell. So clearly, they're deploying those GPUs on the cloud, and it's contributing in terms of additional revenue, which is where the beat comes from in terms of why that growth rate accelerated.
And Anurag, I'm just kind of looking at the, Microsoft, Satya Nadella, the CEO. He's been infusing Microsoft's entire product line with AI technology from partner OpenAI. How much of an advantage is partnering with OpenAI? How much advantage does that give Microsoft?
I think it's only in terms of time. So, before all the others catch up and try to do the same thing, I think it's a land grab thing at this point of, try to get as much as you can, get people hooked into these products with OpenAI. And then, but I'm fairly certain other companies, everybody from Google to Amazon will have a similar, infrastructure for other people to play with. They currently have it already. It's just that it's not getting infused in products that quickly.
What exactly are Microsoft's AI services? What are some examples of how that company is basically deploying AI, especially for these enterprise customers?
Yeah, the first and the foremost is they run OpenAI's backend. So you use more ChatGPT, they make more money off of it, and that's the number one place we see the growth rate. Now we calculate that to somewhere around $1 billion a quarter at this point, run rate of all AI services added in for Microsoft. So that's a very big number, or annualized at $4 billion. The second part is a product called GitHub, where they have infused OpenAI services, so it helps people code things on a very much faster pace. Then you have Office 365 that also has co-pilots built in using OpenAI services. So I would say their entire suite, same thing for LinkedIn, same thing for other products. So they are using a lot of those R&D dollars from or R&D expertise from OpenAI to improve their own products.
Hey, Mandeep, I'm looking at our good friends at Google. This is an alphabet-free studio, as you know. So our good friends at Google, $80 billion of free cash flow this year, $90 billion next year. I'm a big, use of cash kind of guy. They're buying back $70 billion worth of stock, and they're going to initiate an actual dividend. That's a good thing, right?
Yeah.
Is that a good use of cash? I mean, it's not like they're skimping on CapEx or anything.
They're not, and probably they're following the Apple playbook, where all the free cash flow you generate, you use it for buybacks and dividend and CapEx increases. I mean, look, Google did raise their CapEx guide by almost 60-70%. So clearly, I think that's what investors want them to do, and they can't acquire any companies. So this is probably the best use of the cash,
How do you compare that with Meta? Because earlier in the week, it seemed like the Meta investors were not very happy about increased spending on, AI initiatives.
I think Meta is one of the top 3 companies when it comes to generative AI, and they are exposed in a positive way. It's just they don't have a cloud business like Amazon, Microsoft, and Google have. So all the CapEx they do is going for their own infrastructure, for their own apps, which is very important, and it's helping them actually improve their ad targeting recommendation engines, but they also have a money-losing Reality Lab segment. And investors just want to discern how much are you continuing to lose on Reality Labs versus the AI CapEx, which is, I think, the good CapEx. So that's why you saw that stock reaction.
All right, Anurag, I'm looking ahead. That's what I do. Next Thursday after the close, Apple is going to report earnings. Their stock is down 11% year to date, really underperforming what it considers its peers, being the Metas, the Amazons, the Microsofts of the world here. What do you need to see next Thursday on that conference call after the close?
Yeah, any comments about stabilization in China is the only catalyst. Other than that, I mean, I don't see anything that can, I would say, change the mood for what's happening with Apple, primarily because iPhone sales is what drives company, and there are no leading indicators that will give us any signs that that can improve anytime soon.
Can I ask about Snap?
Oh,
Paul.
Mandeep's this.
I mean, I know we were talking about, the larger companies and the larger earnings, but I mean, Snapchat, this was the first time that we're seeing the stock higher. The prior 7 earnings reports, the stock just absolutely tanked after the earnings. So is this a turnaround for Snap?
I mean, look, for a company like Snap, which is not profitable, they are sort of driven by how the overall digital ad market is doing. And in this case, the print from Meta and Alphabet shows digital ad market is coming back. You're seeing a rebound, even though the small business sentiment is still quite weak. And if there's a TikTok ban, there is no doubt that Snap is one of the beneficiaries, both in terms of engagement as well as ad dollars moving to their platform. And we saw a glimpse of that in their print when they said their advertisers actually grew 85% and their brand ad revenue grew 12%, which is the first time in the last 4 quarters their brand ad actually is positive.
All right, Mandeep Singh, thank you so much. Mandeep Singh, Anurag Rana, they are senior technology analysts for Bloomberg Intelligence. They drive our global technology research effort at Bloomberg Intelligence. 2 of the best on the street. We appreciate getting them. Again, big numbers, good numbers out of the tech companies last night. Snap on the smaller cap side, 20 billion market cap. And then, of course, Microsoft and Google. And again, all those stocks higher. As we talked with Anurag, a big Thursday next week when Apple reports its earnings after the close. A lot of pressure, I think, on that company to, as Anurag said, kind of give some clarity about China. I'm not sure they can. That might just be one of those issues that's going to be hanging over this company for many quarters to come. I don't know. And then, of course, their play on AI. They do have a developer event on May 7th.
Right.
That's also going to be highly anticipated. Maybe that's an opportunity for Apple to come out and say, here is our AI strategy.
And a new iPad, right?
Yeah. I mean, I still have my iPad, the original one. I don't know. But I put everything on the phone these days. I rarely use the iPad. It's just everything's on the phone. But we'll see. So good numbers there, and that's lifting those tech numbers are lifting the Nasdaq today up 1.8%, outperforming the S&P 500 that is up 1%. So again, big tech leading the way here. I'm calling out gold again because it's up again another $4, $2,336 an ounce. The gold bugs are very happy these days. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Emily, and Lisa. There's no end to campus protest over the war in Gaza. Rubber bullets were apparently fired at demonstrators at Emory University in Atlanta, where more than 24 people were arrested. Police clashed with protesters at Ohio State University just hours after they gathered last night. Columbia University officials are trying to negotiate with protesters who've been camped out on campus for 10 straight days. Brown University political science Wendy Schiller says that these protests don't appear to be swaying policymakers in Washington.
Congress and the president just signed a bill and are now sending aid to Israel, humanitarian aid to Gaza, but aid to Israel, and that's military aid. So they have not been effective in thwarting or stopping U.S. support for Israel. So now the question is, what is their audience and what do they want to accomplish?
Wendy Schiller at Brown University was on Bloomberg Daybreak. Secretary of State Antony Blinken has met with Chinese President Xi Jinping. Blinken stressed that it is important to manage the differences between the two countries over bilateral, regional, and global issues. Blinken said that while the U.S. would like to forward common goals, it is important not to compromise on some issues such as the invasion of Ukraine by Russia.
Fueling Russia's defense industrial base not only threatens Ukrainian security, it threatens European security. Beijing cannot achieve better relations with Europe while supporting the greatest threat to European security since the end of the Cold War.
Secretary Blinken highlighted progress in bilateral cooperation in military communications, narcotics, and AI. Lawyers for Donald Trump are continuing their cross-examination today. The former tabloid publisher David Pecker at the criminal trial of the former president. New York City prosecutors accuse him of hiding hush money payments to an adult film star. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks on the rise. The Nasdaq up more than 1.5%, more than 296 points. The S&P 500 more than 1% at 52 points. The Dow up 0.5% or 175 points. Over to commodities we go. We have spot gold higher at $2,332 an ounce. Brent crude at $89 a barrel. NYMEX crude at $83 a barrel. Heading over to currencies, the yen weakens past 157 per dollar. That slide accelerates. We have the dollar stronger. The euro is weaker. The British pound weaker. Bitcoin down 1% at 63,979. That is your Bloomberg Business Flash. We'll send it back to you, Paul and Emily.
All right, Lisa Mateo, thank you so much. We appreciate that. Emily, Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Lots of earnings coming out this week. We also had, in addition to the tech names, we also had a lot of big energy companies report. Exxon, Chevron reported. Let's break it all down with Vince Piazza. He's a senior equity research analyst covering the oil and gas space for Bloomberg Intelligence, joining us from Philadelphia via Zoom. So, Vince, let's break it down. Let's start with Exxon Mobil. Looks like they missed a little bit here on some of their earnings. Give us the lowdown from Exxon Mobil.
Well, look, I think here's the takeaway we're telling investors and listeners, right, that this is about cash. Cash is king. Yes, they missed. They telegraphed some of that miss. It's really on lower natural gas prices, margins, a lot of timing effects and maintenance issues, one-timers really. But if you think about ExxonMobil this quarter, I want you to say cash is king. Free cash flow of over $10 billion this quarter. That's a $40 billion run rate annualized. You know, they paid out something like $6.8 billion distributions, dividends, and also share buybacks. $33 billion of cash on the balance sheet at the end of Q1. This is the lowest financial leverage they've had in roughly a decade. So, yes, earnings did miss. That seems to be dragging it down roughly 4% this morning. But the main takeaway for us is that they're in a really strong position balance sheet wise. They're generating capital. They're paying dividend to 3% yield, and they're buying back stock. The Pioneer acquisition, at least from what I heard, it doesn't really seem that there's much in the way that's going to push the closing of that deal past the first half. So once that deal closes, Paul, you're looking at a stock buyback run rate of roughly $20 billion a year. So I think they're in a fairly good position, probably better than this 4% clip that you're seeing this morning. And I think, quite frankly, better than what Chevron had to offer.
Yeah, break down Chevron for us. That company, adjusted EPS beat, upstream earnings beat, but the cash flow from operations for the first quarter, $6.8 billion versus estimates of $7.8 billion.
Yeah, so, you know, again, cash is king, right? They posted GAAP free cash flow of just under $3 billion, yet they paid out $3 billion of divvies and another $3 billion in share repurchases. You know, if you compare the financial leverage, right? Exxon is net debt to cap of roughly